Welcome to this video on the regulatory framework for ACCA financial reporting. The regulatory framework involves the IFRS standard setting process and general legal context. The conceptual framework provides a set of accepted theoretical principles for accounting standards. Elements of the regulatory framework include national laws, securities exchange rules, accounting principles, tax regulations, and supranational regulations. Harmonization in financial reporting allows for preparing information consistently and using the same rules globally. This makes it easier to compare entities for informed investment decisions and control tax. Barriers to harmonization include variations in countries' social, political, and economic contexts, different legal systems, and the costly process of creating a full set of harmonized accounting rules. Key institutions involved in the standard-setting process are the IFRS Foundation, IASB, IFRS-IC, and IFRS-AC. The typical procedure for a new IFRS begins with the IASB identifying a topic and appointing a committee. Next is issuing a discussion paper and then publishing an exposure draft. Finally, after public comments, the IASB publishes the final IFRS. Thank you for watching this video. Welcome to this video on the conceptual framework for ACCA financial reporting. The conceptual framework is a set of accepted theoretical principles. Its purpose is to guide the bodies that design financial reporting standards. The principles-based approach lays down the general principles that govern financial accounting, linking the objectives of financial reporting and the principles. Conversely, the rules-based approach involves detailed regulations that all companies must follow, leaving little room for independent interpretation. The conceptual framework offers many advantages. It provides meaningful guidance, helps avoid, quote, firefighting, makes accounting standards harder to circumvent, and enhances the credibility of financial reporting, reducing influence from vested interests. The goals of the conceptual framework include helping apply IFRS, promoting harmonization, assisting auditors in forming opinions, helping the IASB develop future IFRS, aiding in the interpretation of financial information, and providing information on IASB's work. Key areas of guidance within the conceptual framework include the objective of financial reporting, the qualitative characteristics of financial information, definitions, recognition, and measurement rules for principal elements of financial statements, and concepts of capital and capital maintenance. Recognition and measurement relate to elements for measuring performance, providing financial information about the reporting entity useful for investors and lenders. For example, Standard IAS 40 allows changing the measurement approach from the cost model to the fair value model. Thank you for watching this video on the conceptual framework. Welcome to the second part of our video on the conceptual framework for ACCA financial reporting. Let's review the qualitative characteristics. They are divided into fundamental and enhancing characteristics. Fundamental characteristics include relevance and faithful representation. Enhancing characteristics are comparability, verifiability, timeliness, and understandability. Relevance means the information is capable of making a difference to the decisions made by its users. Relevance is further broken down into predictive value, which helps predict future performance, and confirmatory value, which confirms the accuracy of past evaluations. Materiality is a characteristic related to relevance. Information is material if omitting or misstating it could influence the decisions of users. Faithful representation means the information is complete, containing all necessary details, neutral, free from bias, and free from error. Here are some examples of what it means for information to be complete, neutral, or free from error under faithful representation. Comparability allows users to compare an entity's trend over time and compare the performance of different entities. This is achieved through consistency and disclosure. Verifiability means that financial information should be capable of being confirmed. Timeliness refers to making information available to users in time to be useful for their decision-making. Understandability means that excluding difficult information from financial reports would make them less useful or potentially misleading. Finally, when considering the advantages of the conceptual framework, there is a trade-off between the quality of information and the cost of providing it. Thank you for watching this video on the conceptual framework. Welcome to this video on the elements of financial statements for ACCA financial reporting. We will cover recognition and measurement, starting with the going concern assumption. This assumes the entity will continue operations for the foreseeable future. The ultimate parent produces consolidated financial statements for public use. The elements of financial statements are divided into two areas: measurement of financial position, which includes assets, liabilities, and equity, and measurement of performance, which includes income and expenses. Assets are resources controlled by the entity as a result of past events. They are expected to generate future economic benefits. Control is the key, as legal ownership is not essential. The expectation of future economic benefits means an asset must have value to the reporting entity by converting the resource into a flow of benefits. Liabilities represent an entity's present obligation arising from past events. Settlement of a liability results in an outflow of resources embodying economic benefits. This obligation can be legal or constructive. In the statement of financial position, assets represent benefits flowing into the company, and liabilities represent benefits flowing out. Equity is the residual interest in assets after deducting liabilities. Measurement of performance includes income, which is an increase in economic benefits, and expenses, which is a decrease. Changes in assets, liabilities, and equity, not resulting from shareholders' capital or dividends, form income and expenses. Recognizing assets requires a probability of future economic benefits to the entity and a reliable measurement of the asset. Similarly, recognizing liabilities requires a probable outflow of economic benefits and a reliable measurement of the outflow. For measurement of performance, income is an increase in asset or decrease in liability, which must be measured reliably. An expense is a decrease of asset or increase in liability, also measured reliably. Thank you for watching this video. Welcome to this video on measurement bases and capital maintenance for ACCA financial reporting. Measurement is the process of determining the monetary values for elements in the statement of financial position and the statement of comprehensive income. Measurement bases include historical cost, reliable value, current cost, and present value. Let's review an example. A company bought a new machine for $100,000 with a 5-year useful life and 0 residual value using the straight-line depreciation method. The annual depreciation charge is $20,000. After 2 years, the accumulated depreciation is $40,000, resulting in a carrying amount of $60,000. We also have a current cost of $80,000 and transport costs of $6,000. Expected production is $30,000 per year for the next 3 years, with $2,000 in annual repair costs. The realizable value is calculated as the current cost minus the transport costs, which is $80,000 minus $6,000, equaling $74,000. Net benefits for the next 3 years are $28,000 per year. Using a 10% discount rate, the overall present value of those net benefits is $69,632. Advantages of historical cost include being easy to calculate and understand, objective, error-free, easy to verify, and simplifying the forecasting of future carrying amounts. The main disadvantage of historical cost is that it does not reflect the current value of assets or liabilities. In current cost accounting, monetary items are fixed by contract, such as cash. Non-monetary items, like non-current assets, depend on a specific measurement approach. Current cost accounting restates financial statements to current economic conditions. Inventory and non-current assets are current, with changes reflected in income. Monetary items remain constant. An advantage of current cost accounting is that it provides financial statements with more relevant information. Disadvantages include being more subjective, complex, less reliable, and difficult to apply to non-current assets. Monetary items remain at historical cost, which may not be relevant. The financial concept of capital is net assets, or equity. The physical concept of capital is productive capacity, or operating capability. Under the financial concept, profit is the increase in value from the beginning to the end of the period in normal or real terms. The physical concept defines profit as an increase in physical productive capacity, which requires the adoption of current cost accounting. Thank you for watching this video on measurement bases and capital maintenance. Welcome to this video on fair value measurements, focusing on recognition and measurement, as part of the ACCA financial reporting series. Fair value measurement, governed by IFRS 13, is referenced in multiple standards like IAS 16, IAS 40, IAS 41, and IFRS 9. The rules aim to ensure consistency and comparability in financial reporting. The definition of fair value under IFRS 13 is an exit price, independent of the intention or ability to sell. It is a market-based measurement derived from an ordinary transaction with adequate market exposure and involvement of market participants. The IFRS 13 framework for fair value measurement involves several steps: identifying the asset or liability, determining the highest and best use for non-financial assets, identifying the principal or advantageous market, and selecting a valuation technique. For example, when valuing a plot of land, the highest and best use could be for residential development or as a warehouse, which influences the valuation performed. The principal market has the highest volume and level of activity for the asset or liability. If a principal market doesn't exist, the advantageous market is used, which maximizes the amount received for an asset or minimizes the amount paid to transfer a liability. Valuation techniques include the market approach, which uses market transactions, the income approach, which discounts future amounts, and the cost approach, which estimates the fair value of replacing the asset. These techniques rely on a hierarchy of inputs, and the types of inputs used must be disclosed. The hierarchy of inputs is categorized into 3 levels. Level 1 uses unadjusted quoted prices in active markets for identical assets or liabilities. Level 2 uses observable inputs other than quoted prices from active markets. Level 3 uses unobservable inputs, which should be minimized in the measurement. Thank you for watching this video on fair value measurements. Welcome to this video on IFRS 10 Groups, Part 1, within the ACCA FIFO Financial Reporting Framework. We are covering the concepts and principles of groups and consolidated financial statements according to IFRS 10. A parent company and its subsidiaries, like Subsidiary A and Subsidiary B, form a group for consolidated financial statements. Although the parent and subsidiaries are legally separate entities, consolidated financial statements present them as a single economic concept, like a single business. Consolidated financial statements combine the assets and liabilities of the parent and replace the investment cost with the subsidiary's assets and liabilities. They indicate the resources and obligations of the group. Next, we will review the rules for assessing whether a relationship constitutes control, a key concept under IFRS 10. Investor control exists when an investor has power over the investee, exposure or rights to variable returns, and the ability to use its power to affect those investor returns. Investor power is defined as the ability to direct the activities of the investee. This can be evidenced through voting rights or the rights to appoint key management personnel. An investor has rights to variable returns when those returns vary with the investee's performance. The investor must be able to use its power to affect the returns it receives from the investee. IFRS 10 requires consolidating statements using uniform accounting policies. If different policies are used, appropriate adjustments must be made. Consolidated financial statements combine like items. Consideration must be given if the parent and subsidiary statements have different reporting dates. If a subsidiary's reporting period differs from the parent's, the subsidiary should prepare additional financial information. If unable, the parent must use the subsidiary's adjusted financial statements. Thank you for watching this video on IFRS 10 Groups. Welcome to this video on IFRS 10 Groups, Part 2, focusing on ACCA financial reporting. We are covering the concepts and principles of groups and consolidated financial statements under IFRS 10. Note that providing exemptions can be potentially risky and dangerous. You may choose not to prepare consolidated financial statements if the parent is a wholly owned subsidiary, debt or equity are not publicly traded, or no financial statements were filed with a regulatory body. This is also true if the ultimate parent produces consolidated statements available for public use. IFRS 10 exemption disclosure requires stating that the exemption was used, listing significant investments in subsidiaries, joint ventures, and associates, and describing the accounting method for investments in separate financial statements. Circumstances where a subsidiary is excluded from consolidated financial statements include when the subsidiary is deemed immaterial, thus omitting it from standard consolidation procedures. Thank you for watching this video on IFRS 10 Groups. Welcome to this video on IAS 40, Investment Property, Part 1, for ACCA financial reporting. Investment property, under IAS 40, refers to a tangible non-current asset. It is a land or building held to earn rentals or for capital appreciation. Investment property is not used for the production or supply of goods, services, administration, or for sale in the ordinary course of business. It is held by the legal owner or a lessee under a finance lease agreement. Property can be classified into property, plant and equipment, investment property, or inventory, depending on its use and intention. Examples of investment property include land held for long-term capital appreciation, land held for currently undetermined future use, and buildings leased out under an operating lease. It also includes vacant buildings held to be leased out, and property under construction for future investment use. Conversely, a property is not considered investment property if it is held for use in production, supply of goods, services, or administration, or if it is held for sale. This also applies to property being constructed for third parties or leased out under a finance lease. Some properties may have dual uses, meaning they are held for both own use and for rentals or capital appreciation. For an office building with floors occupied by the owner and rented to tenants, if the portions cannot be sold separately, it is an investment property only if the owner's portion is insignificant. If separate, it's split between investment property and property, plant, and equipment. Now let's move on to the second part of this video, on IAS 40, investment property. At initial recognition, investment property is measured at cost. If purchased, cost relates to the purchase price and direct expenditure. If self-constructed, it follows the same rules as measuring assets under construction. For subsequent measurement, entities can choose between the cost model or the fair value model. Changing from the fair value model to the cost model is discouraged, as it won't increase relevancy. Under the cost model, the asset's carrying amount is its cost minus depreciation and impairment losses. Under the fair value model, the value is determined at the end of the period without charging depreciation, following IFRS 13 for fair value. It is important to note that the use of independent external appraisers or surveyors is not a requirement for determining the fair value. IAS 40 assumes a reliable fair value determination at the end of each period. If this is not possible when the fair value method is selected, the entity should use the cost model. This exemption applies only at initial recognition. The IAS 40 fair value model differs from the IAS 16 revaluation model. IAS 40 takes changes in fair value to profit or loss and charges no depreciation. IAS 16 charges depreciation and takes revaluation gains to OCI. Transfers into and from investment property, such as an owner-occupied building becoming a rented building, impact the carrying amount. Under the cost model, the asset is transferred at its current carrying amount. Under the fair value model, the asset must be revalued using IAS 16 first. When transferring out of investment property, the cost model transfers the asset at its current carrying amount. The fair value model first updates the asset's fair value, and any gain or loss goes to the profit and loss statement. Thank you for watching this video on IAS 40, investment property. Welcome to this video on borrowing costs, covered under IAS 23 of ACCAFR, financial reporting. IAS 23 covers borrowing costs related to the acquisition, construction, or production of a qualifying asset. A qualifying asset takes a substantial period, generally 1 year or more, to get ready for its intended use or sale. Examples of qualifying assets include manufacturing plants, investment properties, and power generation facilities. Inventories and intangible assets can also be considered qualifying assets, along with maturing whiskey, for which applying IAS 23 is a choice. Borrowing costs are interest and other costs incurred when borrowing funds. This includes interest expenses, finance charges from finance leases, and exchange differences from foreign currency borrowings. Costs are directly attributable if they could have been avoided had the expenditure on the qualifying asset not been made. Borrowing funds can be specific to a qualifying asset or for a general purpose. Identifying which costs are directly attributable requires professional judgment and relates to the actual borrowing costs incurred. If general borrowing is used for a qualifying asset, the borrowing costs are capitalized using a capitalization rate. This rate reflects the weighted average of the borrowing costs and is applied to the expenditure incurred on the qualifying asset over a given period. For example, if an entity has a corporate bond at a 5% yield and a bank loan at a 6% interest rate, the capitalization rate is calculated as 5.8%. Using this 5.8% capitalization rate on an expenditure of 2.5 million euros results in 145,000 euros being capitalized. The overall annual interest is €435,000, leaving €290,000 as an interest expense in the profit or loss. Capitalization of borrowing costs begins when expenditures for the asset and borrowing costs are incurred, and necessary activities for preparing the asset for its intended use or sale are in progress. Capitalization should be suspended during extended periods when active development of the asset is interrupted. However, capitalization is not suspended during temporary delays. Capitalization ceases when all activities necessary to prepare the qualifying asset are complete. If usable parts are ready while construction of remaining parts continues, capitalization ceases on a proportional basis. Thank you for watching this video on IAS 23, Borrowing Costs. This video covers IAS 16 on Property, Plant, and Equipment, focusing on measurement at initial recognition as the first part of this series. We are covering IAS 16, Property, Plant, and Equipment, which deals with tangible non-current assets and their measurement at initial recognition and subsequent expenditure. Property, plant, and equipment, or PPE, are tangible non-current assets held for use in the production or supply of goods or services, for rental, or for administrative purposes, and are expected to be used for more than one period. Items outside the scope of IAS 16 include investment properties under IAS 40, PPE classified as held for sale under IFRS 5, biological assets under IAS 41, and mineral rights or reserves. Initial recognition of PPE includes the purchase price, plus import duties and non-refundable taxes, less any trade discounts or rebates. Costs directly attributable to PPE include employee benefits from construction or acquisition, initial delivery, handling, installation, professional fees, site preparation, and borrowing costs for qualifying items. Costs not directly attributable to PPE include general overheads, startup costs, the cost of introducing new products or services, and staff training costs. An initial estimate for dismantling or removing PPE is capitalized and provisioned. For example, a €10 million cost in 4 years at a 5% interest rate has a present value of €8.227 million, which is debited to PPE and credited to a provision. The total initial cost of the PPE is the construction and transportation cost, which is €60 million, plus the present value of the dismantling and removal cost of €8.227 million, totaling €68.227 million. Over the 4 years, the provision grows due to finance costs. For example, in year 1, the finance cost is €411,000, gradually increasing the provision until the total balance reaches €10 million at the end of year 4. Subsequent expenditure on PPE is recognized if the cost is reliably measured and future economic benefits are probable. Servicing and maintenance are expensed, but major costs enhancing economic benefits, such as overhauls or replacement of major components, are capitalized. Examples of enhancing economic benefits include reinforcement of a warehouse floor, which can increase productivity and extend the useful life. Major inspections or overhauls include major reconstruction or development work and regular inspections of assets like aircraft. When replacing a major component, significant parts of the PPE are depreciated separately. The second part of this video series focuses on depreciation under IAS 16, Property, Plant, and Equipment. We will cover important definitions of depreciation, the 3 common depreciation methods, and the starting and ending dates for depreciation. Depreciation is defined as the systematic allocation of the depreciable amount of an asset over its useful life. Useful life is the expected period to derive economic benefits, not the overall potential life. This is measured by the expected available for use period for straight line and reducing balance methods, or the expected number of production units for the units of production method. For a company car with a potential life of 10 or more years, if the company replaces it after 3 to 5 years, the useful life is considered 3 to 5 years. The depreciable amount is the cost of a PPE item less its residual value. Under the revaluation model, the cost is replaced with the valuation. Residual value is the estimated amount from disposal after deducting costs of disposal, based on the age and condition at the end of the useful life. For a new office building with a useful life of 10 years, the residual value is imagined as the current price for a 10-year-older building, not a projected future price. For most non-current assets, the residual value is lower than cost. Land is not depreciated. but land used for extractive purposes has a residual value lower than cost. The common depreciation methods are straight line, reducing balance, and units of production. The chosen method should reflect the pattern of consuming economic benefits. The straight line method is used for linear benefits, while the reducing balance or units of production methods are used for declining or variable benefits. All methods can be applied to intangibles. Consider a company that acquired a machine with a purchase price of 800,000 euros, an estimated residual value of 50,000 euros, an expected useful life of 5 years, and an expected total production capacity of 100,000 units. Using the straight line method, the depreciable amount is 750,000 euros. The annual depreciation charge is calculated as 750,000 euros divided by 5 years, which equals 150,000 euros. To use the reducing balance method, we first need to calculate the depreciation rate. For this example, let's assume a rate of 50%. With the reducing balance method, the depreciation charge is highest in year 1 at 400,000 euros, and the written down value is 400,000 euros. This continues, with the written down value decreasing each year until year 4, reaching the residual value of 50,000 euros. Another way to apply the reducing balance method is using the sum of the digits approach. The units of production method ensures the depreciation charge reflects the proportion of overall capacity utilized over a given period. If 15,000 units are produced in year 1, the depreciation charge is 112,500 euros. This method is popular in industries with high swings in production volumes, like oil and gas, where no depreciation is charged during periods of no production. Depreciation begins when the asset is available for use in the right location and operable condition, and the costs are reflected in the carrying amount. Depreciation ceases at the earlier of when the asset is classified as held for sale or the date it is derecognized from the statement of financial position. Depreciation cannot be delayed if the asset is available for use and must be charged even during idle periods, unless depreciated under the units of production method. This third part of the video focuses on measurement after initial recognition under IAS 16, property, plant, and equipment. After initial recognition, there is a choice between two measurement methods. The cost model, which uses cost less accumulated depreciation and impairment losses, and the revaluation model, which uses fair value less accumulated depreciation and impairment losses. IAS 16 has no restrictions on using the revaluation model. IAS 16 requires a consistent approach for each specific class of asset, meaning similar assets should be grouped together. Examples of asset classes include land, buildings, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment, and bearer plants. The asset class of buildings can include both office facilities and manufacturing facilities. IAS 16 prohibits adopting different approaches in different geographical locations. If a building is revalued in one city, the same approach must be followed in other locations. The revaluation model requires that the fair value is reliably measured. This is generally performed by an external professional valuer, and the frequency of revaluation depends on the volatility of the asset's fair value. For non-volatile assets, revaluation may be every 3 to 5 years, while volatile assets require annual revaluation. The revaluation of property, plant, and equipment under IAS 16 is applicable to tangible non-current assets and can follow either the cost model or the revaluation model. This video provides a trick to apply the standard, which is easy to follow. Examples of tangible non-current assets under IAS 16 include depreciable assets and non-depreciable assets. Consider a land plot, a non-depreciable asset, recognized at a $20 million cost on the date of purchase. At year-end, its fair value is $25 million. The carrying value increases by $5 million, which is recognized in other comprehensive income. The accounting entry for this revaluation involves debiting property, plant, and equipment and crediting other comprehensive income, revaluation surplus, for the $5 million increase. Welcome to this video on IAS 16 property, plant, and equipment, focusing on measurement after initial recognition. This content is for ACCA financial reporting. For tangible non-current assets under IAS 16, there are two measurement methods after initial recognition. The cost model uses cost minus accumulated depreciation and impairment losses. The revaluation model uses fair value minus accumulated depreciation and impairment losses. IAS 16 has no restriction on the revaluation model. IAS 16 requires a consistent approach for each specific class of assets. This means grouping together similar assets. Examples of asset classes include land, buildings, machinery, ships, aircraft, motor vehicles, furniture and fixtures, office equipment, and bearer plants. A single asset class, like buildings, can encompass different facilities, such as an office facility and a manufacturing facility. IAS 16 prohibits adopting different measurement approaches for the same class of assets in different geographical locations. For example, if you revalue a building in one city, you must follow the same model in other locations. The cost model is generally easy to apply. However, the revaluation model can be more complex to apply due to the nature of fair value estimation. We will now look at examples involving depreciable and non-depreciable assets under the revaluation model. Consider a land plot, a non-depreciable asset, purchased for $20 million. At year-end, the fair value is $25 million. The $5 million increase in carrying value is recognized in other comprehensive income. The accounting entry for this upward revaluation is a debit to property, plant, and equipment, and a credit to other comprehensive income, specifically the revaluation surplus. Now, assume the fair value at the second year-end is 18 million euros. This represents a decrease in value. IAS 16 states that a decrease in fair value is recognized in profit or loss unless it reverses an earlier upward revaluation. In that case, the decrease is first taken to other comprehensive income. The land's value dropped by 7 million euros. We debit 5 million euros to other comprehensive income to reverse the surplus and debit 2 million euros to profit/loss. We credit property, plant, and equipment for the total 7 million euros decrease. At the third year end, suppose the fair value increases again to 26 million euros. An upward revaluation that reverses a previous fall is recognized within profit or loss up to the amount of the previous loss. Any amount exceeding the reversal is recognized in other comprehensive income, which is the normal treatment. The asset increased in value by 8 million euros. We debit property, plant, and equipment for 8 million euros. We credit 2 million euros to the profit/loss account to reverse the previous loss, and credit 6 million euros to other comprehensive income for the new surplus. For the frequency of revaluation, there is no set period imposed by the standard. The key is that the carrying amount and fair value must not materially differ. For simplicity, we assume revaluation happens at year-end. Let's look at a depreciable asset example. Cost of 60 million euros, useful life of 12 years, and nil residual value. This results in an annual depreciation of 5 million euros. 3 years later, the accumulated depreciation is 15 million euros, making the carrying amount 45 million euros. If the fair value is now 54 million euros, there is an upward revaluation of 9 million euros. The accounting entry for this upward revaluation is a debit to property, plant, and equipment, and a credit to other comprehensive income or revaluation surplus for 9 million euros. After the revaluation, the asset's new carrying amount is 54 million euros. Assuming the remaining useful life is unchanged at 9 years and residual value is nil, the revised annual depreciation is 6 million euros. The difference between the revised depreciation, 6 million euros, and the original depreciation, 5 million euros, is 1 million euros. This difference is transferred from the revaluation surplus to retained earnings over the remaining 9-year useful life. The double entries for this transfer are a debit to revaluation surplus and a credit to retained earnings for 1 million euros. If the asset is sold, the remaining revaluation surplus is similarly transferred directly between these two accounts. No revaluation surplus should be reflected in profit or loss on the sale. When revaluing a depreciable asset, the accumulated depreciation needs adjustment. The first method is to eliminate it against the gross carrying value of the asset. The asset cost is 60 million euros, and accumulated depreciation is 15 million euros, leaving a net carrying value of 45 million euros before revaluation. To eliminate the accumulated depreciation of 15 million euros, you debit accumulated depreciation and credit the asset cost account. The revaluation is then recorded as a debit to asset cost for 9 million euros and a credit to revaluation surplus for 9 million euros. The alternative method for dealing with accumulated depreciation is to proportionately restate it. Under this method, You first compute the relationship between the fair value after revaluation, 54 million euros, and the carrying value before revaluation, 45 million euros, which results in a factor of 1.2. The revised asset cost is 72 million euros, which is 60 million multiplied by 1.2. The difference of 12 million euros is debited. The revised accumulated depreciation is 18 million euros, so a credit of 3 million euros is needed. The missing credit entry of 9 million euros is the revaluation surplus. Although the cost and accumulated depreciation balances are different under the two methods, the revaluation gain or loss and the revaluation surplus remain the same. The adoption of the revaluation model is a change in accounting policy. IAS 16 does not require retrospective change, which relieves companies from restating the previous year's balance. Thank you for watching this video on IAS 16. Welcome to this video on IAS 38 Intangible Assets, focusing on measurement after initial recognition for ACCA financial reporting. Measurement methods include the cost model and the revaluation model. The carrying amount under the cost model is cost minus accumulated amortization. For the revaluation model, it is fair value at the date of revaluation minus accumulated amortization and impairment losses. Under IAS 38, a consistent approach to choosing between these models must be applied to all intangibles in the same class, such as brands, software, licenses, copyrights, and patents. For the revaluation model, an active intangible asset market must exist. IAS 38 does not define an active market, but IFRS 13 considers it as transactions with sufficient frequency and volume to regularly provide pricing information. There are rules for internally generated intangibles. Few intangible assets like patents, trademarks, and music or film rights have active trading. Active markets involve tradable terms, and there are typically no active markets for firm-specific intangibles like brands. Let's review an example. An asset is purchased for a fair value of €48. Subsequent quarter-end fair values are €53, €42, and €50. At the end of quarter one, the intangible asset increases from €48 to €53. This €5 gain is debited to intangible assets and credited to other comprehensive income. At the end of quarter two, the fair value drops to €42, requiring an €11 reduction. The previous €5 revaluation is reversed by debiting other comprehensive income. The remaining €6 loss is debited to profit or loss. At the end of quarter three, the fair value rises to €50. The €8 increase reverses the prior €6 loss through a credit to profit or loss, and the remaining €2 increase is credited to other comprehensive income. When calculating amortization, key factors include the useful life of the asset, the amortization method to be used, and the asset's residual value. Assets with a finite useful life are amortized over their life or production units. Assets with an indefinite useful life, meaning no foreseeable limit, are not amortized but are subject to an annual impairment test. Indefinite useful life means the expected flow of benefits is currently unseen. This should be reviewed at every reporting period. If the useful life is reclassified as finite, amortization starts once the estimate is revised. The amortization approach should reflect the expected pattern of benefits flow. Common methods include the straight line method, reducing balance method, and sum of digits approach. Residual value is the estimated amount from the disposal of an asset, less estimated cost of disposal at the end of its useful life. For intangibles with a finite useful life, the residual value is generally required to be 0. Thank you for watching this video on IAS 38 Intangible Assets. This video, part of the ACCA Financial Reporting Series, introduces IAS 36 Impairment. We are accounting for transactions in financial statements, focusing on IAS 36 Impairment of Assets. Assets are resources controlled by an entity expected to generate future economic benefits. IAS 36's purpose is to ensure assets are presented in the statement of financial position at no more than their recoverable amount. There are two main scenarios. If the carrying amount is less than the recoverable amount, there is no issue. If the carrying amount is greater, the asset is impaired, leading to a write-down or write-off and an impairment loss. The recoverable amount is the higher of an asset's fair value less costs of disposal and its value in use. Fair value is the universal selling price, and value in use is the discounted value of future cash flows. Consider an example of a non-current asset with a carrying amount of $5.3 million. We have scenarios for selling or keeping the asset, along with net cash inflows and a 10% discount rate. The fair value less costs of disposal is $3.6 million. The value in use, calculated by discounting future cash flows, is $4.92 million. Since the recoverable amount, $4.92 million, is less than the carrying amount, $5.3 million, a write-down of $0.38 million is required. For accounting entries regarding tangible non-current assets under IAS 16, the impairment loss account within the profit and loss statement is debited, and the non-current asset net book value account is credited. A cash flow forecast includes cash inflows from continuing use of the asset, cash outflows necessary to generate those inflows, and net cash inflows from the asset's disposal at the end of its useful life. Cash flow projections should be based on reasonable and supportable assumptions derived from the most recent financial budgets or forecasts and should not exceed a maximum period of 5 years. For extrapolations, use a steady declining growth rate for subsequent years. Ensure the rate does not exceed the long-term average growth rate and keep the projection realistic. The discount rate is the rate investors would require for a similar investment profile. It must be pre-tax and independent of the entity's capital structure. This section covers the second part of IAS 36 impairment, focusing on the indicators of impairment. IAS 36 applies to most assets but has exceptions, including inventory, investment property, deferred tax assets, and assets held for sale, which are covered by other standards. An impairment review is conducted at the end of each reporting period. If indicators are found, an impairment test is performed to see if the carrying amount is higher than the recoverable amount. If no indicators are found, generally, no impairment test is needed. Some assets require annual impairment testing, regardless of indicators. These include recognized goodwill and intangible assets with indefinite useful lives, or those not yet available for use. Impairment indicators can be broadly categorized into internal and external sources. Internal sources of impairment include obsolescence or physical damage, changes in the way the asset is used, and evidence of bad economic performance compared against the budget. External indicators include a significant decline in the asset's market value, adverse changes in the external environment, and an increase in the market interest rate. Remember, the occurrence of an indicator is not the same as impairment. This part of the video focuses on cash-generating units, the third section of our look at IAS 36 impairment. As a recap, an impairment review is performed at the end of the reporting period. If indicators are found, an impairment test is necessary to compare the carrying amount with the recoverable amount. Readily available fair values exist for assets like cars traded in secondary markets. However, for buildings and equipment, utilizing specialist appraisers and surveyors is often necessary. Value in use is based on estimated future cash flows derived from assets. It can be difficult to assess because very few assets generate independent cash flows. Assets like machines, buildings, sales departments, raw materials, finished goods, and vehicles often do not have independent cash flow generating potential. This leads us to the concept of the cash generating unit. A cash generating unit, or CGU, is the smallest identifiable group of assets that generates cash inflows independent from other assets. For a retail store chain, with managers controlling product range and pricing, and centralized support activities, the definition of independent cash inflows suggests that each store is typically considered a CGU. Corporate assets like headquarter buildings and IT systems must be allocated to the various CGUs benefiting from them before an impairment test. This is also true for goodwill, resulting from acquisition synergies. This final part of our series on IAS 36 impairment focuses on testing cash-generating units for impairment. Here is a list of assets within a CGU, including goodwill, property, plant, and equipment, with their carrying amounts and fair value less costs of disposal. Goodwill cannot be transferred or sold, has no market value, and is not systematically amortized. However, it has a carrying amount and must be tested for annual impairment. For this CGU example, the estimated value in use is 120 million euros, and the fair value less costs of disposal is 118 million euros. Generally, if no impairment indication exists for a CGU, no impairment test is needed, except for goodwill. If an indication exists, a quantitative test determines the amount of loss. The impairment framework compares the carrying amount to the recoverable amount, which is the higher of the fair value less cost of disposal and the value in use. The CGU's total carrying amount is 150 million euros. The recoverable amount is the higher of the value in use, 120 million euros, and the fair value less costs of disposal, 118 million euros. So 120 million euros is the recoverable amount. Since the carrying amount of 150 million euros is greater than the recoverable amount of 120 million euros, an impairment write-down of 30 million euros is required. This loss must be allocated among the various assets in the CGU. The allocation order for impairment losses is applied first to reduce the carrying amount of any goodwill. Second, it is applied to the other assets of the CGU, but not below their recoverable amount. Applying the 30 million euro loss, goodwill is fully written off by 25 million euros. The remaining 5 million euro loss is allocated to the intangible asset. The new total carrying amount is 120 million euros, equal to the recoverable amount. Impairment losses are generally reversible if the recoverable amount of the CGU increases. The entity recognizes a corresponding credit in the profit and loss statement. However, a reversal of impairment loss on goodwill is not allowed. Thank you for watching this video on IAS 36 impairment. Welcome to this video on IAS 41 agriculture, an introduction to this financial reporting standard. The goal of IAS 41 is to establish rules for the accounting of agricultural activity, including the management of the transformation of biological assets and agricultural produce. IAS 41 has demanding rules for measurement, often using fair value. This differs from other asset categories. IAS 41 applies to biological assets with the exception of bearer plants. Bearer plants, such as grapevines or olive trees, are used in the production of agricultural product for over one period and are accounted for under IAS 16. However, the produce from these plants is treated under IAS 41. IAS 41 also applies to agricultural produce at the point of harvest and government grants related to biological assets. Exclusions from IAS 41 include land related to agricultural activity and intangible assets related to agricultural activity. For example, a sheep falls within the scope of IAS 41, as does the point of shearing. However, once sheared, the wool and its products are outside the scope of IAS 41. Sugar beet is a biological asset that is not a bearer plant. It falls within the scope of IAS 41, but is outside the scope once harvested and turns into agricultural produce. There are separate measurement rules for biological assets and agricultural produce. Biological assets are measured at fair value less estimated costs to sell, with any gain recorded in profit or loss. An exception exists if reliable fair value cannot be determined, in which case cost less accumulated depreciation and impairment is used. In the example of a sheep, at birth it is recognized as an asset, and a gain is recorded in P&L. As it grows, the carrying value increases. Adult sheep are valued at fair value, with gains and losses adjusted. Agricultural produce is measured at fair value less selling costs at the point of harvest, with no exception to the fair value treatment. The gain is recorded in profit or loss, and the fair value less cost to sell is used to record inventory under IAS 2. When a sheep is sheared and wool harvested, the fair value less cost to sell is estimated. The gain is recorded in the income statement, and the asset immediately becomes inventory. A major criticism of IAS 41 is recognizing profit before sale, as the majority of profit is recognized at the time of shearing. Proponents argue that the fair value requirement discourages excessive harvesting. The fair value approach encourages sustainability, such as a company owning a forest. It prevents companies from boosting income by cutting and selling more trees, encouraging investment in relevant biological assets. A key distinction is that assets under IAS 41 are measured at fair value, while assets under IAS 20 are measured at cost less accumulated depreciation. For government grants under IAS 41, unconditional grants are recorded as income when receivable, while conditional grants are recorded only when the conditions are met. Thank you for watching this video on IAS 41 Agriculture. This video, part of the ACCA Financial Reporting Series, focuses on IAS 2 inventories, specifically definition and measurement. IAS 2 applies to several types of inventory, including raw materials, work in progress, finished goods, and goods acquired for resale. There are exceptions to IAS 2, such as work in progress from construction contracts, financial instruments, and certain biological assets and agricultural produce. The measurement provisions of IAS 2 do not apply to inventories held by certain producers or commodity broker traders who measure inventory at fair value less cost to sell. Inventories under IAS 2 include finished goods held for sale, work in progress for production, and materials or supplies to be consumed in the production process. Assets not included in inventories are surplus items of property, plant, and equipment, or other non-current assets intended for sale outside the normal course of business. Inventory is measured at the lower of its cost, or its net realizable value, known as NRV. Initial recognition of inventory cost includes the cost of purchase, costs of conversion, and other costs incurred to bring the inventory to its present location and condition. Costs to bring inventory to its present location and condition include the purchase price, less any trade discounts, plus transport costs, import duties, and other non-recoverable taxes and direct costs. Costs of conversion include direct costs like labor and raw materials, as well as production overheads, applied consistently and non-optionally. Variable production overheads are indirect costs that change with the volume of production, such as energy, indirect material, and indirect labor. Fixed production overheads are indirect costs that remain relatively constant, regardless of production volume. Examples include management expenses, equipment maintenance, and depreciation. The allocation of fixed production overheads is based on normal capacity levels, considering average expected production and any loss of capacity from planned maintenance. For example, with a normal capacity of 100,000 units and 100,000 euros in overheads, each unit absorbs €1. If actual production is 80,000 units, 20,000 euros in unabsorbed overheads are charged to the profit and loss statement. However, if actual production is 120,000 units, The allocation is 100,000 euros divided by 120,000 units, resulting in 0.83 euros absorbed per unit. Disallowed costs that cannot be included in inventory cost are abnormal waste amounts, storage costs, administrative overhead, and selling costs. In limited circumstances, borrowing costs under IAS the 23rd of may be included in the cost of inventory, but this excludes items manufactured in large quantities or over short periods. Capitalization of borrowing costs is limited to inventory, where production extends over a long period of time and production volumes are small. Net realizable value is the estimated selling price of an inventory item, less the estimated costs of completion and the estimated costs to be incurred in the sale. Inventory is measured at the lower of cost or net realizable value. This principle ensures that inventory is not valued above its recoverable amount, especially if it becomes obsolete. Let's review two examples comparing cost versus net realizable value. Inventory 1 is held for resale with a purchase price of 20 euros and a sales price of 18.50 euros, with 2 euros in delivery expense. For inventory 1, the cost is 20 euros per unit. The NRV is 18.50 euros less 2 euros delivery, which is 16.50 euros. Since NRV is lower, a write-down of 3.50 euros is necessary. Inventory 2 is finished goods with a cost of production of 15 euros, a sales price of 22 euros, and a commission of 3 euros. The NRV is 22 euros less 3 euros, equaling 19 euros. Since the cost of 15 euros is lower than the NRV of 19 euros, no write-down is needed. We now move to IAS 2 Inventories Part 2, focusing on cash flow assumptions for inventory valuation. For heterogeneous, non-interchangeable inventory, like vehicles or jewelry, the cost of each item can be individually established. For homogeneous, interchangeable inventory, like small, high-value items, the first-in, first-out, or weighted average cost methods are used. The first-in, first-out, or FIFO method assumes the oldest items are sold first. The ending inventory value reflects the cost of the most recently purchased goods. The weighted average cost, or AVCO, method computes an average unit cost by dividing the total cost of items by the total number of items on hand. The last-in, first-out, or LIFO method is disallowed under IFRS. It is the direct opposite of FIFO, assuming the most recent purchase is the first to be used. Companies can choose between FIFO and AVCO, but must apply the same method to all inventories with similar nature and use. Different methods are allowed for items with different nature and use. Let's work through an example. A company has 0 opening inventory. On December 1st, it buys 70 units at 53 euros. On December 4th, it sells 20 units. On December 13th, it buys 70 units at 58 euros. On December 27th, it sells 60 units. We need to compute the cost of goods sold and closing inventory for both FIFO and AVCO. Using FIFO, the cost of goods sold is 4,290 euros, and the closing inventory is 3,480 euros. The total value remains 7,770 euros. Using AVCO, the average rate for the second sale is 55.92 euros. The cost of goods sold is 4,415 euros, and the closing inventory is 3,355 euros. Comparing the two methods, the total value of purchases is 7,770 euros for both. FIFO results in a lower cost of goods sold and a higher closing inventory value than AVCO. Thank you for watching this video on IAS 2 inventories. Welcome to the video on IFRS 9 Financial Instruments Part 1 as part of the ACCA Financial Reporting module. We are covering accounting for transactions in financial statements, specifically IFRS 9 on financial instruments. The need for dedicated standards stems from the growth in the global economy, increasing complexity, and the popularity of financial derivatives. IFRS 9 replaces the previous accounting standard and addresses the measurement of unrealized gains and losses. There are 3 key IFRS standards for financial instruments: IAS 32 for presentation, IFRS 7 for disclosures, and IFRS 9 for the instruments themselves. IAS 32 covers the definition, classification, and presentation of financial instruments. IFRS 7 addresses the extent of information to disclose. IFRS 9 deals with recognition and measurement, including classification, debt instruments, financial assets at amortized cost, financial liabilities, and derecognition. This video focuses on IAS 32 and IFRS 9. Other topics like IFRS 7 and IFRS 13, which relates to fair value measurement, are outside the scope of this particular video. A financial instrument is defined by a contract where one party recognizes a financial asset and the other recognizes a financial liability or an equity instrument. For example, with a bond, the investor records a financial asset and the issuer records a financial liability. Another example involves shares. The investor recognizes purchased shares as a financial asset, and the issuer records the shares issued as equity. A financial asset is any asset that is cash, a contractual right to recover cash or other financial assets like trade receivables, a contractual right to exchange financial assets or liabilities under favorable terms, such as derivatives, or an equity instrument of another entity, like shares. A financial liability is a contractual obligation to deliver cash or other financial assets, such as trade payables, or to exchange financial assets or liabilities under unfavorable terms, like derivatives. An equity instrument, such as ordinary shares, is any contractual item that represents a residual interest in the assets of an entity after deducting all its liabilities. Let's review an example using a bank's statement of financial position to identify financial assets, liabilities, and equity. Cash is directly a financial asset. Bonds are financial assets for the bank, but a financial liability for the U.S. Treasury. The bank's deposit liability is a financial liability to the bank and a financial asset to Company A. Mortgage loans are financial assets for the bank and financial liabilities for the borrowers. Shares in Company B are financial assets for the bank and an equity instrument for Company B. Equity, as shares issued by the bank, is also made up of financial instruments. Thank you for watching this video on IFRS 9 financial instruments. Welcome to the second video in our series on IFRS 9 financial instruments for ACCA financial reporting. We will focus on the classification of debt instruments under IFRS 9. Classification is based on meeting both the business model and the SPPI criteria, determining if a debt instrument is measured at amortized cost or fair value through other comprehensive income. The business model assesses how an entity manages financial assets to generate cash flows. It's a matter of fact, not intent, and is determined at a high level of aggregation. Models include held to collect, held for trading, and held to collect and for sale. If a debt instrument passes the SPPI test, its measurement depends on the business model. Held to collect is measured at amortized cost, while held to collect and sale is measured at fair value through OCI. Instruments not passing SPPI or those held for trading are measured at fair value through profit or loss. The SPPI criterion means contractual cash flows consist solely of payments of principal and interest on the outstanding principal. A simple debt instrument is a typical example that meets this criterion. A debt instrument complies with the SPPI test if its contractual cash flows are consistent with a basic lending arrangement. The interest element should include a market rate of interest and a margin for credit risk. Other components may cause the test to fail, although not all embedded options lead to failure. For example, a bond with a variable interest rate of 1-month Euribor plus a 50 basis point margin meets the SPPI criterion, as cash flows comprise principal and interest aligned with a basic lending arrangement. Debt instruments that fail the SPPI criterion often carry additional features or coupons that increase cash flow volatility. Options like prepaying borrowings, extending the term, or linking interest to unleveraged inflation generally do not violate the criterion. Convertible bonds, which consist of a debt instrument and an option to convert to a fixed number of shares, are an example of a debt instrument that typically fails the SPPI criterion. The option means cash flows do not reflect the time value of money, which is inconsistent with a basic lending arrangement. Another example of failure is debt instruments, where interest is indexed to the debtor's performance, such as EBIT, EBITDA, or an equity price index. This inconsistency means the cash flows do not reflect the debtor's preference and are not consistent with a basic lending arrangement. To summarize the SPPI criterion, most debt instruments qualify. Prepayment or extension options usually do not cause failure, but embedded options increasing cash flow volatility do. Instruments meeting the criterion are measured at amortized cost or fair value through OCI, while those that fail are measured at fair value through profit or loss. Thank you for watching this video on IFRS 9 Financial Instruments. Welcome to the third video on IFRS 9 Financial Instruments, presented by ACCA Financial Reporting. We are continuing with the accounting for transactions and financial statements under IFRS 9. Financial assets are recognized when an entity becomes a party to the contract. Initial recognition is at fair value, which equals the price paid, with an adjustment for transaction costs. IFRS 9 initial recognition requires classification into an appropriate category to determine subsequent measurement and presentation. The three categories are fair value through profit or loss, fair value through other comprehensive income, and amortization cost. In subsequent accounting under IFRS 9, instruments classified as fair value through profit or loss and fair value through other comprehensive income are measured at fair value. Gains or losses are recognized in profit or loss for the former and in other comprehensive income for the latter. For an example, shares purchased at $100. If the fair value is $120 in year one, it is a $20 gain. If classified as FVPL, the gain is in PL. If classified as FVOCI, the gain is in OCI. If the asset at FVOCI is sold, equity instrument gains or losses are not reclassed to PL, but debt instrument gains or losses are reclassed to PL. Initial recognition for the amortization cost category is adjusted for a loss allowance. It is amortized over its life at the effective interest rate, which is the internal rate of return or IRR. Classification of financial assets into these categories depends on the business model and the SPPI criterion. Fair value through profit or loss is the preferred method unless the two additional conditions, the business model and SPPI criteria, are met simultaneously. Financial assets measured at amortization cost must meet both the business model criterion of held to collect and the SPPI criterion, meaning cash flows represent only principal and interest. Examples include loans and trade receivables. Financial assets measured at fair value through OCI must satisfy the business model criterion of held to collect and sale and the SPPI criterion. An example of this is bonds. For equity instruments, such as shares, they can be measured at FVOCI, provided they are not held for trading, as determined on an instrument-by-instrument basis. This classification is irrevocable, and the SPPI criterion does not apply. Financial assets are measured at fair value through profit or loss if they are not classified into the other two categories. This includes debt instruments not satisfying the SPPI criterion, assets held for trading, and equity instruments not classified at FVOCI, or if the designation reduces measurement inconsistency. Let's review a bank example. The statement of financial position includes cash, bonds, mortgage loans, and shares as assets. Liabilities include deposits, and equity includes shares issued. For the Treasury bonds example, the business model can be held for trade, held to collect and sell, or held to collect. The classification depends on the business model and the SPPI criterion. For mortgage loans, if the SPPI criterion is satisfied, the asset can be classified as FVOCI or amortized cost, depending on the business model being held to collect and sell or held to collect. If the SPPI criterion is not satisfied, the asset must be classified as FVPL. For shares in Company B, the default classification is FVPL. However, if there is an irrevocable designation that the asset is not held for trading, it can be classified as FVOCI. In summary, IFRS 9 classification of financial instruments depends on whether they are debt, derivative, or equity instruments. Classification is determined by the SPPI criterion and the business model, which can be held to collect and sell, or held for trading. Thank you for watching this video on IFRS 9 Financial Instruments. This video, part of the ACCA Financial Reporting Series, focuses on IFRS 9 financial instruments. We are discussing financial assets measured at amortized cost, which applies to debt instruments like bonds, trade receivables, and loans granted. This measurement requires a, quote, held to collect business model and adherence to the SPPI criterion, meaning cash flows are solely payments of principal and interest. The definition of amortized cost under IFRS 9 starts with the initial recognition, fair value plus transaction costs. Subsequent steps involve subtracting principal repayments and adding or subtracting cumulative amortization using the effective interest rate method, with a further adjustment for loss allowances. The effective interest rate method exactly discounts all cash flows to the gross carrying amount, not adjusted for loss allowance. The carrying amount is adjusted at the reporting date for the interest amount and any contractual cash flows generated. Let's review example 1 of a financial asset measured at amortized cost. A 2-year zero coupon bond with a $1,000 nominal value purchased for $810 and a $16 transaction cost. This bond has no interest and is redeemed at nominal value. The initial recognition is the purchase price plus the transaction cost, resulting in $826. This is debited to financial assets at AC and credited to cash. With a contractual cash flow of $1,000, the effective interest rate is determined to be 10%. For year 1, the recognized income is the initial carrying amount of $826 multiplied by the 10% EIR, which equals $83. This is debited to financial assets at AC and credited to interest income. The amortized cost at the end of year 1 is $909. In year 2, the recognized income is $909 multiplied by 10%, equaling $91. The entry debits financial assets at AC and credits interest income. The amortized cost at the end of year 2 is $1,000. Upon redemption, we record the receipt of $1,000 by debiting cash and crediting financial assets at AC. The cumulative interest income over 2 years is $174, representing the total profit generated. Next, we examine financial assets measured at fair value through other comprehensive income, or FVOCI. This applies when the business model is held to collect and sell, and the SPPI criterion is met. Reporting requirements are similar to amortized cost, including initial recognition with transaction costs and EIR computation. However, gain/loss is presented in OCI. Using the same investment example, the initial recognition for FVOCI involves debiting financial assets at fair value through OCI and crediting cash for $826. For year 1, the interest income recognized using the 10% EIR is $83. The amortized cost at the end of year 1 is $909. If the fair value is $950, a $41 adjustment is recorded, debiting the financial asset and crediting OCI. If the bond is disposed of, the FV adjustment is reclassified from OCI to profit and loss. Example 2 is a 2-year bond at 6% with a nominal value of $100,000, purchased for $100,859 and a transaction cost of $1,000. This bond generates $6,000 in cash flow in year 1 and $106,000 in year 2. The initial recognition is $100,859 plus $1,000, totaling $101,859. The journal entry debits financial assets at AC and credits cash. The effective interest rate for this bond is 5%. For year 1, the recognized income is $101,859 times 5%, which is $5,093. Cash of $6,000 is received. The amortized cost at the end of year 1 is $100,952. For year 2, the recognized income is $100,952 times 5%, which is $5,048. The final receipt is $106,000, and the amortized cost at the end of year 2 is nil. The cumulative income over both years is $10,141. The total profit generated from this transaction can also be calculated using the cash flows, initial purchase price, and transaction costs. Thank you for watching this video on IFRS 9 financial instruments. Welcome to part 5 of the IFRS 9 financial instruments video. This section focuses on financial liabilities. A financial liability is an obligation to deliver cash or another financial asset, or to exchange financial assets or liabilities under unfavorable terms. Initial recognition of a financial liability is at fair value. If subsequent measurement is at amortized cost, the fair value is adjusted by costs directly attributed to the acquisition. Financial liabilities are categorized as measured at fair value through profit or loss, or at amortized cost. Amortized cost is recognized using the effective interest rate, which discounts contractual cash flows. Subsequent measurement involves beginning amortized cost, adding interest expense, and deducting payments made, using the effective interest rate. Financial liabilities involve an obligation to deliver cash or a financial asset and the payment of interest. Equity instruments involve the right to participate in residual value and the distribution of dividends. Preference shares can be classified as a financial liability if redeemable and providing a guaranteed return, treating payments as interest. Irredeemable preference shares are generally considered equity instruments. Applying substance over legal form, redeemable preference shares are financial liabilities due to fixed obligations and principal payment. Irredeemable shares are equity, as they have no fixed obligations. A compound instrument, such as a convertible bond, has at least two components with different economic characteristics. Split accounting separates the liability and equity components. Let's review an example of a compound instrument using 3,000 convertible bonds with a 2-year maturity and a 5% annual coupon. The present value of cash flows is calculated using the market interest rate, leading to the determination of the equity component by subtracting the present value from the overall proceeds. Convertible bonds, as compound instruments, can be accounted for using either split accounting or measuring the entire instrument at fair value through profit or loss. To summarize, we covered the definition, initial recognition, categories, and subsequent measurement of financial liabilities, including the distinction between financial liabilities and equity instruments, and the accounting for compound instruments. Thank you for watching this video on financial liabilities under IFRS 9. Welcome to this video on IFRS 9, Financial Instruments, focusing on the derecognition of financial assets and liabilities. Financial liabilities are removed when the liability is extinguished, which can happen through discharge, cancellation, or expiration. Examples include the repayment of a bond or settlement of a credit purchase. A financial asset is derecognized when the contractual rights to the future cash flows have expired or the asset has been transferred, meaning there is no longer a right to those future cash flows. For the transfer of a financial asset, the contractual rights to receive cash flows are transferred, and there is an obligation to pass these cash flows to another entity. This obligation is for the amount actually received, and remittance occurs without delay. An illustration of a financial asset transfer is a factoring transaction, where a trade receivable is transferred and an advanced payment is received. This can occur with debtors paying directly to the factor or not. To qualify for derecognition, the transfer of a financial asset requires the transfer of risks and rewards. You must compare the exposure before and after the transfer, considering all financial risks such as credit, interest, price, and currency risk. Evaluating the impact of a factoring transaction involves assessing the transfer of risk and reward. Risk often relates to credit risk, while reward is the inflow upon settlement. This evaluation differs based on whether the transaction is with or without recourse. In a factoring transaction with recourse, the factor can claim reimbursement, meaning risk is not transferred, and there is no derecognition. Without recourse, risk is transferred, and derecognition is triggered. If derecognition of a financial asset is triggered, the treatment is similar to a disposal. If derecognition is not triggered, the consideration is recognized as a financial liability. Thank you for watching this video on the derecognition of financial instruments under IFRS 9. Welcome to this video on IFRS 16 leases, focusing on initial measurement within ACCA financial reporting. Our scheme of study for IFRS 16 includes 3 modules. This video covers Module 1, which focuses on the definition of a lease contract, other standard terms, and regulation and measurement at inception. A lease is a contract, or part of a contract, that conveys the right to use an underlying asset for a period in exchange for consideration. The term lease has a broad scope and includes things like the hire or rent of office space. At inception, the lessee recognizes 2 things: a lease liability and a right-of-use asset. The right-of-use asset represents the lessee's right to use the underlying asset over the lease term. The lease liability is measured at the present value of certain payments. These include fixed or variable payments, amounts payable under residual value guarantees, exercise price of purchase options reasonably certain to be awarded, and termination penalties. To compute the present value, an appropriate discount rate must be identified. This is generally the interest rate implicit in the lease. If this rate is not determinable, the lessee should use their incremental borrowing rate. The lease term includes the non-cancelable period of the lease. It also includes periods covered by an option to extend the lease, if reasonably certain to be awarded. or periods covered by an option to terminate the lease, if reasonably certain not to be awarded. The right-of-use asset is initially measured at cost. This cost comprises the initial value of the lease liability, any lease payments made at or before commencement, initial direct costs incurred by the lessee, and estimates for dismantling, removing, or restoring the asset. Let's consider an example. A company signs a 2-year non-cancelable lease for equipment with a 6-year useful life. There's a 1-year extension option that is reasonably certain to be exercised. Payments are $402 at the end of each year, and initial legal costs are $200. The incremental borrowing rate is 10%. Since the 1-year extension is reasonably certain, the total lease term is 3 years, the 2-year contract plus the 1-year extension. We calculate the present value of the lease payments over the 3-year term using the 10% discount factor. The total outflow of $1,206 results in an initial carrying amount of the lease liability of $1,000. The initial carrying amount of the right-of-use asset is calculated as the lease liability plus the incremental legal cost. In this example, $1,000 plus $200 equals $1,200. The transaction is recorded by debiting the right-of-use asset for $1,200. We credit cash for the $200 legal costs and credit lease liability for $1,000. IFRS 16 offers exemptions from recognizing all lease contracts. These apply to short-term leases, where the lease term is less than 12 months, and leases where the underlying asset is of low value, like laptops or small furniture. When these exemptions are applied, no lease liability or right-of-use asset is recognized. Instead, the lessee recognizes lease payments on a straight line or other systematic basis. For a 3-year low-value laptop lease with a 6-month rent-free period and monthly rent of $60, the total payments are $1,800. Allocating this over 36 months results in a monthly charge of $50, which is then accounted for as shown here. Thank you for watching this video on IFRS 16 leases. Welcome to the second part of our video on IFRS 16 leases, focusing on subsequent measurement. This video will cover the subsequent measurement of both the right-of-use asset and the lease liability, building on the recognition and initial measurement concepts from the previous video. For the right-of-use asset, subsequent measurement generally uses the cost model. Initial cost less accumulated depreciation and impairment losses. Unless a different approach is elected, like the revaluation or fair value model, the asset is depreciated over the shorter of its useful life, or the lease term. The lease liability's carrying amount is calculated by taking the opening balance, adding the interest charge for the period, and subtracting the amount of the payment actually made. The interest charge is recognized as an expense in the profit and loss statement. Let's work through an example. A company enters a 2-year non-cancelable lease for a property, plant, and equipment asset. Key details include a 3-year lease term, $402 annual payments at year-end, and a 10% incremental borrowing rate. The total lease term is 3 years, the 2-year contract plus the 1-year extension option, which is reasonably certain to be exercised. The initial carrying amount of the right-of-use asset is the sum of the lease liability and the incremental legal costs, totaling $1,200. The initial carrying amount of the lease liability is the present value of the lease payments over the 3-year lease term, which sums up to $1,000. For subsequent measurement of the right-of-use asset, we assume the straight-line depreciation method over the 3-year lease term, resulting in an annual depreciation charge of $400. The overall interest charge for the lease liability is the total lease payments of $1,206 minus the initial carrying amount of $1,000, resulting in $206. In year 1, the opening balance is $1,000. Interest charge is 10% of $1,000, which is $100. Subtracting the $402 payment made results in a closing balance of $698. For year 2, the opening balance is $698. The interest charge is 10% of $698, which is approximately $70. Subtracting the $402 payment gives a closing balance of $366. In year 3, the opening balance is $366. The interest charge is 10% of $366, which is $36. The closing balance after subtracting the $402 payment is 0, meaning no further obligation. The total interest charge over the 3 years is the sum of the annual interest charges. $100 plus $70 plus $36, which is $206. Here is the summary table for the subsequent measurement of the lease liability, showing the opening balance, interest charge, payment, and closing balance for each year. The lease liability needs to be split between current and non-current. The non-current liability for year 1 is calculated as the difference between the closing balance of year 1 and the closing balance of year 2, which is $332. Let's review another example with payments required at the beginning of each year. The payment amount is $365.50, and all other details remain the same. Since the first payment occurs at the beginning of the lease, only years 2 and 3 are discounted. The present value of the lease payments is $634.50. The initial carrying amount of the right-of-use asset is the sum of the lease liability, the initial payment, and the incremental legal costs, totaling $1,200. Depreciation remains $400 annually. For the subsequent measurement of the lease liability, we adjust the balance after the payment in year 2 and year 3. The closing balance for year 3 is 0. For year 1, the current liability is $365.50, and the non-current liability is $332.50. Thank you for watching this video on the subsequent measurement of leases under IFRS 16. This video, as part of the ACCA Financial Reporting Series, focuses on IFRS 16 leases, specifically the accounting for a sale and leaseback transaction. In a sale and leaseback agreement, the original owner, the seller or lessee, transfers the title of property, plant, and equipment to another party, the buyer or lessor, for immediate cash flow. The seller then leases the asset back, retaining the right to use it. The accounting for a sale and leaseback transaction first requires determining if the transfer of the asset qualifies as a sale under IFRS 15. This is based on indicators of transfer of control, such as the buyer having legal title and the significant risks and rewards of ownership. If the transfer does not qualify as a genuine sale under IFRS 15, the seller or lessee continues to recognize the transferred asset and simultaneously recognizes a financial liability, as the transfer proceeds are treated as a loan. If the transfer satisfies the requirements of IFRS 15 and is accounted for as a genuine sale, the seller or lessee measures the right-of-use asset at the value of the rights retained and recognizes a gain or loss for the rights transferred. Let's look at an example. An asset with a book value of $7.2 million and a 12-year remaining useful life is sold at fair value of $10 million and simultaneously leased back with 3 annual payments of $2.3 million. The present value of lease payments is $5.7 million. The carrying amount of the right-of-use asset is $4.1 million, based on the rights retained. The recognized gain is $1.2 million, which is based on the rights transferred. To record the transaction, we debit cash for $10 million and right-to-use asset for $4.1 million. We credit property, plant, and equipment for $7.2 million, lease liability for $5.7 million, and gain on disposal for $1.2 million. Thank you for watching this video on IFRS 16 leases and sale and leaseback accounting. This video covers IAS 10, focusing on events after the reporting period for ACCA financial reporting. Financial statements are prepared for a specific period. IAS 10 deals with events occurring between the reporting date and when financial statements are authorized for issue. The scope of IAS 10 covers the period from the reporting date to when the financial statements are authorized. Events after the reporting period are categorized as either adjusting or non-adjusting. Adjusting events provide evidence of conditions that existed at the reporting period end. Examples of adjusting events include the impairment of an asset at the end of the reporting period, settlement of a court case, or the discovery of fraud or errors. Non-adjusting events include abnormal changes in asset prices, destruction of a major production plant, or changes in tax laws announced after the reporting period. Adjusting events require adjustments in the financial statements and provide additional evidence about conditions that existed at the end of the reporting period. Non-adjusting events are triggered by conditions arising after the end of the reporting period, such as business decisions made afterward. For adjusting events, amounts in the financial statements are adjusted. For material non-adjusting events, disclosure of the nature and financial effect is required, but no adjustments are made to the financial statements. Special events include dividend proposals, which are non-adjusting. If the going concern assumption is not appropriate, financial statements should be prepared on a breakup basis. Thank you for watching this video on IAS 10. Welcome to the ACCA Financial Reporting video, focusing on IAS 37, Provisions, Contingent Liabilities, and Assets. Liabilities represent an entity's present obligations, resulting from past transactions or events, which will lead to an outflow of resources containing economic benefits upon settlement. A provision is a liability of uncertain timing or amount. Conditions for recognition include a present obligation, a probable settlement, and a reliable estimate of the amount. Provisions are part of liabilities on the statement of financial position, along with payables. A typical provision example is a repair guarantee, unlike an unpaid electricity invoice, which is a payable. An obligation event creates a legal or constructive obligation, meaning the entity has no realistic alternative but to settle the obligation. For a provision to be recognized, the probability of the resource outflow occurring must be greater than 50%, which is considered probable. Remember that a provision is defined as a liability of uncertain timing or amount. Creating a provision directly impacts a company's reported profit or loss by debiting the cost and crediting the provision account within liabilities. This sometimes requires analysis of the event. Before IAS 37, practices included setting up provisions as a transfer of resources or an aggregation of expected future outflows, sometimes leading to inadequate disclosure difficulties. IAS 37 excludes several areas from its scope, such as employee benefits, financial instruments, insurance contracts, construction contracts, income taxes, and leases. In an example of 10,000 phones sold, the provision for minor defects at $40 each is $20,000. For significant faults at $100 each, the provision is $30,000. Key aspects of provisions include the best estimate rule with gross of tax presentation, the need for review, prohibition of offsetting, and compliance with disclosure requirements. Thank you for watching this video on IAS 37. Welcome to this video on IAS 37, Provisions, Contingent Liabilities, and Assets. We will explore key concepts for financial reporting. This video covers provisions and events after the reporting period, focusing on contingencies. We'll look at the conditions necessary for provisions and how to account for uncertain inflows. The accounting treatment for liabilities and assets depends on the likelihood of the outcome. For liabilities, a probable outcome means we recognize it, while a remote outcome requires no disclosure. While IAS 37 doesn't provide specific percentages, likelihood is generally categorized as remote, possible, probable, or virtually certain, with associated percentage ranges. Reviewing the liability treatment, we see that recognition is required for probable and virtually certain outcomes, while possible outcomes require disclosure. Consider a bank sued for erroneous advice, resulting in a $1 million loss, where the attorneys estimate less than a 50% chance of losing. This is an example of a contingent liability. For such cases, disclosure in the notes is required. This should include a description of the legal situation, the estimated financial effect, and any indication of uncertainties. Two possible actions exist when dealing with uncertainties. The first instance involves a possible obligation from past events, depending on uncertain and uncontrollable future events. In this example, a company is forced to withdraw a product, creating a present obligation to offer refunds, which is deemed probable, but the amount is impossible to estimate due to a lack of information. One condition for recognizing a provision is a reliable estimate. If this is not met, even if the outflow is probable, we disclose a contingent liability and monitor it continuously. For contingent assets, disclosure is allowed only when the outcome is probable. Recognition is only permitted when the outcome is virtually certain. A contingent asset is a possible asset arising from past events, whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future events not wholly within the entity's control. There is different treatment for assets and liabilities due to the concept of prudence. We are more cautious to recognize income and more prudent to recognize losses. IAS 37 outlines 4 types of provisions: warranty or guarantee provisions, provisions for onerous contracts, restructuring provisions, and environmental or decommissioning provisions. Warranties represent a legal or constructive obligation, with a provision recognized at the time of sale. Companies use past experience to estimate the number of claims and the cost of repair or replacement. A provision for onerous contracts is created when unavoidable costs exceed economic benefits, such as in a non-cancelable lease agreement. The provision equals the sum of future payments subject to discount. The increase in the discounted provision amount over time is known as the unwinding of the discount. This is recorded as a debit to finance cost and increases the carrying amount of the provision. A provision for restructuring under IAS 37 relates to a program planned and controlled by management that materially changes the scope or way of conducting the business. Examples of restructuring include the sale or termination of a line of business, the closure or relocation of activities, and changes in management structure. Restructuring activities involve substantial costs, which are often known upfront. The question is whether a provision should be recognized for these costs. Conditions for recognizing a restructuring provision include the existence of a formal plan and the announcement of the plan to those affected, specifying the expected costs and time of implementation. The restructuring provision must only include expenditures directly associated with the restructuring. It excludes costs related to ongoing activities. Excluded costs are those related to future ongoing activities, such as retraining and relocation of employees, or investments in new systems and distribution networks. Environmental provisions are recognized for future environmental costs when a legal or constructive obligation exists. For a mining company, legislation may create a legal obligation, while the company's history of managing environmental damage might create a constructive obligation, even without explicit legislation. A specific prohibition under IAS 37 prevents recognizing provisions for future operating costs and repair expenses that could be avoided by shutting down or selling an asset. Thank you for watching this video on provisions, contingent liabilities, and assets. Welcome to this ACCA financial reporting video on IAS 12, income taxes. We will focus on the accounting for current tax. Current tax relates to income tax, which includes all taxes based on taxable profits. This results in an amount recoverable or payable based on the taxable profit or loss for the period. Current tax is an expense in the current period and a liability if unpaid. It is accounted for prospectively. The expense is recorded as a debit and the tax payable as a credit. Here is an example. If the 2015 tax provision was $280,000 and the payment was $250,000, there was a $30,000 overestimated provision. If the 2016 provision is $200,000, the tax expense recorded is $170,000, which is $200,000 minus the $30,000 overestimation. Thank you for watching this video on IAS 12 and accounting for current tax. Welcome to this video on IAS 12, income taxes, focusing on deferred tax. We will be discussing taxation under the Accounting for Transactions in Financial Statements section. Key concepts include temporary difference and deferred tax. Current tax is an expense in the current period and a liability if unpaid. Let's look at example 1 for the year ended December 31st, 2016. The earnings before interest and tax are $200,000 with an applicable tax rate of 30%. A $1 million loan at 5% was taken out on January 1st, 2016 and is repayable on January 1st, 2017. The income statement shows EBIT of $200,000 with $50,000 interest, leading to a current tax of $60,000 and a net profit of $90,000. The tax return shows a taxable profit of $200,000, leading to $60,000 tax payable at a 30% tax rate. For the year ended December 31st, 2017, the accrued portion from 2016 impacts both the income statement and the tax return. A deduction of $50,000 is reflected in the tax return, leading to $15,000 tax payable. Revisiting 2016, the deferred tax of $15,000 gives a net profit of $105,000 in the income statement. The difference between the current tax and the tax payable is $45,000. The double entries for 2016 include debiting income tax expense $45,000 and deferred tax asset $15,000 and crediting income tax payable $60,000. This is reflected in the statement of financial position with a deferred tax asset of $15,000 and a tax liability of $60,000. For the year ended December 31st, 2017, the deferred tax is a credit of $15,000, resulting in a net profit of $140,000. The double entry is a debit to tax expense and a credit to deferred tax asset for $15,000. In example 2, for the year ended December 31st, 2016, a strategic technology license was acquired for $12 million. It has a 1-year economic life and is fully amortized in the year of purchase. Earnings before tax are $16 million, taxable at 30%. For 2016, the income statement shows an EBT of $16 million with no amortization, resulting in a deferred tax of $3.6 million. The double entry involves debiting tax expense and crediting deferred tax liability for $3.6 million. The double entry for the year ended December 31, 2017, will be to debit the deferred tax liability and credit the tax expense for $3.6 million. Example 3 for the year ended December 31, 2016. EBT is $1.8 million, taxed at 25%. A $120,000 acquisition cost is not an allowable expense for taxation. The tax return includes a $120,000 adjustment, leading to a taxable profit of $1.92 million and a tax payable of $480,000. This is a permanent difference, resulting in no deferred tax element. Thank you for watching this video on IAS 12 and deferred tax. Welcome to the video on IAS 12, income taxes, focusing on deferred tax, Part 2. This is part of the ACCA financial reporting series. Deferred tax is concerned with temporary tax differences, which are the differences between the carrying value of an asset or liability in the financial statements and its tax base. This requires recognizing deferred tax assets and liabilities. Temporary differences are categorized as either taxable temporary differences, which result in additional tax to be paid in the future, or deductible temporary differences, which lead to deductions from income tax computation in the future. A taxable temporary difference occurs when the carrying value of an asset is greater than its tax base, or the carrying value of a liability is less than its tax base. In this first example, the difference between the carrying value of a technology asset and its tax base results in a deferred tax liability of $3.6 million, leading to a debit to deferred tax expense and a credit to deferred tax liability. A deductible temporary difference occurs when the carrying value of an asset is less than its tax base, or the carrying value of a liability is greater than its tax base. For example 2, the accrued interest liability creates a deductible temporary difference. This results in a deferred tax asset of $15,000, debited to deferred tax asset and credited to deferred tax expense. Example 3 involves a machine with a 3-year useful life, straight-line depreciation for accounting, and accelerated depreciation for tax purposes with an income tax rate of 20%. In year 1 of example 3, the difference between the carrying value and the tax base creates a deferred tax liability of $30,000, which is recorded as a deferred tax expense in the income statement and a deferred tax liability in the balance sheet. By the end of year 2, the temporary difference reduces, leading to a new deferred tax liability of $24,000. This requires a reversal entry, decreasing the deferred tax liability by $6,000 and decreasing the deferred tax expense. In year 3, both the carrying value and the tax base become nil. The remaining deferred tax liability of $24,000 is fully reversed, debiting the deferred tax liability and crediting the deferred tax expense. Thank you for watching this video on IAS 12 and deferred tax. Welcome to this video on IAS 12- income taxes, focusing on specific items relevant to ACCA financial reporting. When dealing with taxation under IAS 16 for property, plant, and equipment, and IAS 38 for intangible assets, the revaluation model affects the carrying amount. A deferred tax asset is recognized for the carry forward of unused tax losses and unused tax credits only to the extent that it is probable they will be utilized. This applies to all deferred tax assets. Thank you for watching this video on IAS 12 income taxes. Welcome to this video on IAS 8, which covers accounting policies and accounting estimates as part of ACCA financial reporting. IAS 8 aims to enhance the relevance and reliability of financial statements and ensure comparability with those of other entities. It addresses selecting and changing accounting policies, accounting for changes in estimates, and treating prior period errors. Accounting policies are specific principles and practices an entity uses to prepare financial statements. International Financial Reporting Standards, or IFRS, are the standards and interpretations adopted by the International Accounting Standards Board, or IASB. Materiality refers to how an omission or misstatement of information should be treated. Information is considered material if its omission or misstatement could influence economic decisions based on the financial statements. When selecting an accounting policy, if an IFRS is available, the relevant policy should be determined by applying it. If no IFRS is available, the effect of departure may be immaterial. In the absence of an IFRS, judgment must be used to develop a suitable accounting policy. A reliable policy should provide information relevant to the economic decision-making needs of users. Accounting policies should be selected and applied consistently for similar transactions to maintain uniformity and comparability in reporting. Changes in accounting policies are allowed when required by an IFRS or if the change provides more relevant and reliable information. Changes are not allowed for transactions that differ in substance or are new and previously immaterial. Accounting policy changes can result from the initial application of an IFRS with specific transactional provisions or from voluntary changes. The initial application of an IFRS without specific transactional provisions is also considered. For example, changing from FIFO to weighted average for inventory valuation impacts the financial statements and comparatives for the previous year. This change affects the carrying amount of inventory, the cost of sales figure, and the opening equity balance in the comparative statements for the prior year. A change in accounting policy is typically applied retrospectively, unless this requirement is deemed impracticable because the company cannot apply it. Thank you for watching this video on IAS 8. Welcome to this video on IAS 8, Accounting Policies, Changes in Accounting Estimates, and Errors, part of the ACCA Financial Reporting module. In the process of accounting for transactions, many items cannot be measured with precision, requiring an estimate. Estimation involves judgment based on the latest reliable information, and since estimates are uncertain, they are subject to revision. Changes in accounting estimates involve adjusting the carrying amount of an asset or liability, or the periodic consumption of an asset. These changes result from reassessing expected future benefits and obligations, and can involve items like bad debts, inventory obsolescence, and useful lives of depreciable assets. Changes in accounting estimates are recognized prospectively by including them in profit or loss. This recognition is applied either in the period of change or in the period of change in future periods, depending on the estimate's impact. As an example, if a machine's estimated useful life is revised from 10 to 2 years after 5 years of use, the depreciation charge is adjusted from the beginning of the 6th year. When changing accounting estimates, prior period financial statements are not adjusted. According to IAS 8, if it is difficult to distinguish between a change in accounting policy and a change in accounting estimate, it should be treated as a change in accounting estimate. Prior period errors are omissions or misstatements in an entity's financial statements for one or more periods. These arise from a failure to use or misuse of reliable information that was available when the financial statements were authorized. Financial statements that contain material errors or immaterial errors made intentionally do not comply with IFRS. IAS 8 addresses prior period errors, while potential current period errors are corrected before authorization. Prior period material errors are corrected retrospectively in the first set of authorized financial statements. Retrospective application corrects recognition, measurement, and disclosure as if the error never occurred. Comparative amounts are restated for errors in the comparative period. Correcting prior period errors is similar to changes in accounting policies. For example, if equipment sold before December 31, 2014 was not removed from the books, the 2015 financial statements must adjust the 2014 figures. A prior period error should be corrected by retrospective restatement. If it is impracticable to determine the period-specific effects of an error, the cumulative effect of the error is restated at the earliest date possible. Thank you for watching this video on IAS 8. This video covers ACCA financial reporting focusing on IFRS 5, which addresses non-current assets held for sale and discontinued operations. We are currently in the module on accounting for transactions in financial statements, specifically Section 9, Reporting Financial Performance. The objectives of IFRS 5 are to set out requirements for classifying, measuring, and presenting non-current assets held for sale, and to address the identification and presentation of discontinued operations. We will start by looking at some crucial terms, specifically non-current assets and disposal groups. IAS 1 does not explicitly define a non-current asset. It is generally considered any asset that fails to meet the definition of a current asset. Conditions for a current asset include being realized, consumed, or sold in the normal operating cycle, held primarily for the purpose of trading, expected to be realized within 12 months, or being cash or a cash equivalent. A disposal group is a group of assets disposed of in a single transaction, along with any related liabilities. Non-current assets can be part of a disposal group. An asset is classified as held for sale if its carrying amount will be recovered principally through a sale transaction, and it is available for immediate sale in its present condition. In the first scenario, a company vacating its headquarter building after identifying a buyer means it is available for immediate sale, and IFRS 5 applies. If it intends to use the building until new construction, IFRS 5 does not apply. For a sale to be highly probable, there must be management commitment to sell, an active plan to identify a buyer, the asset must be actively marketed at a reasonable price, the sale is expected within 1 year, and significant changes or withdrawal are unlikely. The probability of shareholders' approval is also considered. If one condition is not met, the asset is not classified as held for sale. Abandoned assets are also not classified as held for sale. We will now discuss other important areas under IFRS 5, specifically measurement and disclosure requirements. Assets held for sale are measured at the lower of their carrying amount, updated before classification, or fair value less costs to sell. These assets are no longer depreciated or amortized. IFRS 13 defines fair value as the price received in an orderly transaction between market participants at the measurement date, essentially the market price. Let's review an example. A machine acquired for $10 million is depreciated at $1 million per year. After 2.5 years, the company decides to sell it. The market price is $9 million, with dismantling costs of $0.2 million. Under IFRS 5, the book value is computed in 3 steps. The first step is to determine the carrying amount as of June 30th, 2017. With 2.5 years of straight-line depreciation, the asset's carrying amount is $7.5 million. The second step is to determine the fair value less costs to sell. The fair value is $9 million, and subtracting $0.2 million in dismantling costs yields $8.8 million. The lower of the two values is selected, the carrying amount of $7.5 million. The machine is classified as held for sale, presented in the SFP at $7.5 million, and no longer depreciated. The initial measurement has 2 possible outcomes. If fair value less costs to sell is greater than the carrying amount, there is no impact. If the carrying amount is greater, a write-down is recognized. In a modified example, if the machine sells for $7 million, the fair value less cost to sell is $6.8 million. This is lower than the $7.5 million carrying amount. The asset is written down to the lower value of $6.8 million, resulting in a $0.7 million loss recognized upon classification as held for sale. Subsequent measurement is needed if the reporting date is before the sale's completion. Certain assets are excluded from IFRS 5, including deferred tax assets, assets arising from employee benefits, financial assets, agriculture assets valued at fair value less costs to sell, and investment properties under the fair value model. For disclosure and presentation, assets and liabilities of a disposal group are presented separately in the SFP, within current assets and current liabilities respectively. Offsetting is not allowed, and major classes must be separately disclosed. Thank you for watching this video on IFRS 5. Welcome to this video on IFRS 5, non-current assets held for sale and discontinued operations, part of the ACC-AFR financial reporting series. Within accounting for transactions, a component of an entity has operations and cash flows distinguishable from the rest of the entity. Not every cash-generating unit is a component of an entity, but a cash-generating unit exists while in use. A discontinued operation is a disposed or held for sale component of an entity. It must represent a separate major line of business or geographical area, or be part of a single coordinated disposal plan. This also includes a subsidiary acquired exclusively for resale. The rules can apply to separate non-current assets or disposal groups, though a single non-current asset is unlikely to meet the definition. A discontinued operation will also be a disposal group at the reporting date, and at least one additional condition must be met. Consider these examples. Management is considering selling a loss-making division next year. The company's branch in Asia was sold this year due to a decision to retreat from Asia markets. Or, the company holds redundant equipment offered at a reasonable price, with the sale expected to complete shortly. IFRS 5 has specific disclosure requirements. Comprehensive income is shown as a single amount, comprising the post-tax profit or loss of discontinued operations and any post-tax gain or loss on the measurement or disposal of these assets. The conceptual framework states that separate disclosure of discontinued operations enhances the predictive value of financial information. This is because future performance is based on continuing operations, contributing to the overarching objective of financial reporting. The amount of post-tax profit or loss includes the revenue, expenses, and pre-tax profit or loss of discontinued operations, as well as the income tax expense. It also includes any gain or loss recognized on measurement to fair value, less costs to sell, or on disposal of the assets. Here is an example calculation. Revenue minus costs equals gross profit. The after-tax profit of the operations plus the after-tax gain from disposal of the non-current assets gives the total profit of the discontinued operation. Other non-current assets or disposal groups that do not meet the definition of a discontinued operation must include any resulting gains or losses in the profit or loss from continuing operations. Thank you for watching this video on IFRS 5. This video covers IAS 33 earnings per share, focusing on computing basic EPS as part of ACCA financial reporting. We will cover definitions and computation of basic earnings per share, adjustments for bonus and rights issues, and the calculation of diluted earnings per share across 3 modules. The core requirement of IAS 33 is that companies must compute and disclose both basic and diluted earnings per share, or EPS. The objective of basic EPS is to measure the interest of each ordinary share and the entity's performance over a given reporting period. The objective of diluted EPS is to measure the interest of each ordinary share while taking into account all dilutive potential ordinary shares. IAS 33 is applicable to entities with ordinary or potential ordinary shares traded in a public market, or those filing statements for issuing shares publicly. This includes both standalone and consolidated financial statements. If a parent presents both, only the consolidated EPS is required. Basic EPS is calculated by dividing the profit or loss attributable to ordinary equity holders by the weighted average number of outstanding shares. The numerator, or the profit or loss, starts with the net profit or loss attributable to ordinary equity holders. This requires excluding the portion of net income attributable to non-controlling interest and an adjustment for preference dividends. The denominator, or the weighted average number of shares, starts with the number of ordinary shares outstanding at the beginning. It is adjusted by shares bought back or issued and multiplied by a time weighting factor to reflect the passage of time. Let's review an example with a net income of $14 million and preference dividends of $200,000. The company had 4 million ordinary shares on January 1st, issued 2 million more on July 1st, ending with 6 million shares on December 31st. The numerator is 14 million minus 200,000, equaling 13.8 million. The denominator is 4 million plus 2 million times 6/12, equaling 5 million. This results in a basic EPS of $2.76. Thank you for watching this video on computing basic EPS under IAS 33. This video, part of the ACCA financial reporting series, focuses on IAS 33 earnings per share, specifically basic EPS with bonus and rights issues. Bonus issues are free shares given to existing shareholders, proportional to their current holdings. IAS 33 requires adjustment to the number of shares used in the earnings per share calculation. Let's consider an example with a net income of $1,250,000. We start with 2 million ordinary shares on January 1st, a 1-for-8 bonus issue on June 1st, and 600,000 shares issued at fair value on September 1st. Bonus shares are treated as if they occurred before the beginning of the year. The 1-for-8 bonus issue results in 250,000 bonus shares. The total weighted average shares is 2,450,000, resulting in an EPS of 51 cents. A rights issue grants existing shareholders the opportunity to buy further shares, proportional to their holdings. If the price is below the market price, a bonus fraction calculation is required, comparing the fair value before the exercise of rights to the theoretical ex-rights fair value. Here's an example for a rights issue with net income of $180,000. We start with 5,000 shares at a market value of $11, followed by a 1-for-5 rights issue of 1,000 shares at $5 per share on July 1st. The theoretical X rights fair value per share is $10, making the bonus fraction 1.1. The adjusted shares for the first half are 5,500, and for the second half are 6,000, totaling 5,750 weighted average shares. This results in an EPS of $31.30 per share. Thank you for watching this video on IAS 33 earnings per share. This video, part of ACCA-FR financial reporting, covers IAS 33 earnings per share, focusing on diluted EPS with convertible shares and bonds. We are covering the reporting of financial performance within accounting for transactions in financial statements. Key concepts include potential ordinary shares, which affect the profit made for each share in issue, leading to changes in basic EPS, also known as dilution. Potential ordinary shares can arise from financial liabilities or equity instruments, as well as options and warrants. A potential share issued has a twofold impact on EPS, an increase in the number of shares and an impact on net income. A negative net effect on EPS indicates a dilutive effect. Diluted EPS requires adjustment of net income and weighted average shares, as if potential shares were actually issued. Shares with a dilutive effect are adjusted, while those with an anti-dilutive effect are ignored. Let's review an example. We have 100,000 ordinary shares and a net income of $50,000. There are also 5% convertible preference shares worth $100,000, convertible at $5 of preferred stock into 2 ordinary shares. Preference shares were issued throughout the year, and the dividend was paid in full. To calculate the basic EPS, we take the net income of $50,000, subtract the preferred dividend, which is $100,000 times 5%, and divide by the ordinary shares of 100,000, resulting in 45 cents. For conversion, the net income increases by $5,000 to $50,000, and the number of ordinary shares increases by 40,000. The resulting EPS is $50,000 divided by the sum of 100,000 and 40,000 shares, which equals 36 cents. Now let's consider convertible bonds. Assume a coupon of 5% per annum, a nominal value of $100,000, and a conversion rate of 2 ordinary shares for each $5. The basic EPS for this scenario is $50,000 divided by 100,000 ordinary shares, which equals 50 cents. If the bonds convert, there is a savings of $5,000 in interest. However, we lose the tax savings on the interest payment. Assuming a 30% tax rate, the net savings is $3,500, resulting in an adjusted net income of $53,500. The number of shares is the same as the previous example, totaling 140,000 shares. The diluted EPS is calculated as the adjusted net income of $53,500 divided by the total shares of 140,000, which results in 38 cents. Thank you for watching this video on IAS 33 earnings per share. This video will focus on IAS 33 earnings per share, specifically examining diluted EPS with options and warrants within the context of ACCA financial reporting. An option or warrant gives the holder the right to purchase ordinary shares at a future date, at a price set in advance. The cash consideration is usually lower than the market value of the shares. When adjusting the basic EPS for options and warrants, there is no adjustment to net income. However, there is an adjustment to the number of ordinary shares, but not by the full number of shares. The adjustment for share options is split into 2 categories: the number of shares available in cash at the actual market price, and shares deemed to be issued for no consideration. Let's review an example. We have 100,000 ordinary shares, options over 20,000 shares, and warrants to buy ordinary shares at $5 per share. The average market price is $12, and the net profit is $500,000. The basic EPS is calculated as net profit divided by the number of ordinary shares. In this example, $500,000 divided by 100,000 equals $5. For diluted EPS, there is no adjustment to net income. The adjustment is made only to the number of ordinary shares, specifically for shares issued without consideration. The proceeds from options are $100,000. If shares are acquired at the market value of $12, 8,333 shares are authorized. The remainder of 11,667 shares are issued for free. Diluted EPS is calculated as the net profit divided by the adjusted number of ordinary shares. This is $500,000 divided by 111,667, which equals $4.48. Earnings per share is a factor in calculating the price to earnings, or PE ratio, which is determined by dividing the share price by the EPS. Limitations of EPS include that it ignores inflation, is a measure of past performance, and can be influenced by accounting policies. Thank you for watching this video on IAS 33 earnings per share. This video introduces IFRS 15 revenue recognition and the 5-step model within the ACCA-FR financial reporting curriculum. This module, on accounting for transactions in financial statements, covers revenue. Later modules will address the particular steps of the 5-step model, costs associated with customer contracts, and presentation and disclosure. The objective of IFRS 5 is to establish principles for reporting to users of financial statements. This includes the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. From the user's perspective, revenue is an important figure that shows performance in respect to sales activities. Rising revenue signals strong performance, while falling revenue indicates potential problems. Revenue recognition has been a controversial issue. Prior to IFRS 15, there were major differences between IAS 18's broad principles and USGAAP's detailed guidance. A joint project between the IASB and FASB clarified the principles for revenue recognition, especially for complex contracts like long-term projects and telecommunications. IFRS 15 was expected to remove inconsistencies and weaknesses, provide a more robust framework, enhance comparability of revenue recognition, improve disclosure requirements, and simplify by reducing requirements. IFRS 15 supersedes several regulations, including IAS 11 on construction contracts, IAS 18 on revenue, and interpretations like IFRIC 13, IFRIC 15, IFRIC 18, and SI 631. However, IFRS 15 excludes various areas, such as lease contracts under IAS 17, insurance contracts under IFRS 4, and financial instruments under IFRS 9. The core principle of IFRS 15 is that an entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration the entity expects to be entitled to in exchange for those goods or services. The 5 steps for revenue recognition are identifying the contract with the customer, identifying the performance obligation, determining the transaction price, allocating the transaction price, and recognizing revenue after satisfying the performance obligation. Consider an example where a laptop producer receives an order for 10 devices and 24 months of support on November 1st, 2016. The client pays $12,400. The standalone prices are $1,000 per laptop and $240 per device for technical service. Step 1 is identifying the contract with the customer, which is the agreement between the company and the client. Step 2 involves identifying the performance obligations. In this example, the obligations are the supply of 10 laptops and the provision of 24 months of technical support. Step 3 is determining the transaction price, which is the total payment received, $12,400. Step 4 is allocating the transaction price to the performance obligations. $10,000 corresponds to the laptops and $2,400 corresponds to the technical support. Finally, Step 5. The obligation to supply laptops is satisfied upon delivery, recognizing $10,000 in 2016. The technical support is provided over 24 months, so the proportional recognition for 2 months in 2016 is $200. Thank you for watching this video on IFRS 15 revenue recognition. This video will focus on IFRS 15 revenue recognition, specifically covering the 5-step model, steps 1 and 2. Step 1 is to identify the contract with the customer. This involves ensuring approval, identifying rights, defining payment terms, assessing commercial substance, and determining probable collection. Under IFRS 15, certain situations require specific considerations, such as the combination of contracts and contract modifications. 2 or more contracts with the same customer near the same time are combined if at least one of these conditions is met. They are negotiated as a single package, the amount of one depends on the other, or the goods/services form a single performance obligation. A contract modification is considered a new contract if the scope increases by adding distinct goods or services, and the prices increase by the standalone price of those goods or services. Step 2 is to identify the promised goods and services. This is necessary to recognize revenue that depicts the transfer of goods or services. For example, a computer hardware manufacturer must identify laptops and services separately before allocating a price. Examples of promised goods and services include the sale or resale of goods, performing a contractually agreed task, constructing an asset, and granting licenses. A key consideration in Step 2 is determining whether the promised items constitute a distinct good or service or a series of distinct goods or services. A good or service is distinct if the customer can benefit from it on its own, and it is separately identifiable from other promises in the contract. In an example from a previous module, delivering laptop chargers before the laptops did not meet the first criterion, as the chargers were useless without the laptops. This resulted in no separate performance obligation and no revenue recognition. A series of distinct goods or services must meet two conditions. The performance obligation is satisfied over time, and the same measure of progress is used for each distinct item. An example is monthly payroll processing. If goods or services are not distinct, they must be combined into a bundle of distinct items and accounted for in a single contract. Exclude activities that only fulfill the contract, such as administrative tasks. When agents are involved, you must determine the obligation. If the obligation is to provide the good or service, the entity is the principal. If it is to arrange for another party, the entity is the agent. If the entity is determined to be an agent, revenue is recognized based on the fee or commission received. Indicators that an entity is an agent include: another party is primarily responsible, no inventory risk, no discretion on pricing, consideration in the form of commission, and not being exposed to credit risk. For example, if an entity acts as an agent for a car manufacturer and sells $20 million in cars with a 10% commission, the revenue recognized is $2 million. Thank you for watching this video on IFRS 15 revenue recognition. Welcome to this video on IFRS 15 revenue recognition. We will cover Step 3, determining the transaction price, and Step 4, allocating the transaction price to performance obligations. Step 3 involves determining the transaction price, which is the amount of entitled consideration. This excludes sales tax and amounts collected on behalf of third parties. Elements considered in determining the transaction price include variable consideration, the existence of a significant financing component, non-cash consideration, and consideration payable to the customer. Variable consideration arises from discounts, rebates, refunds, bonuses, or penalties, often contingent on a future event. For example, a construction company may receive a bonus for timely achievement. To account for variable consideration, two methods can be used: the expected value method or the most likely amount method. One method should be consistently applied. For a construction company expecting a $1 million bonus with an 80% probability of completion by March 2016, the most likely amount is $1 million if this is the single most likely outcome. If the same company has 10 similar contracts, the expected value method may be more suitable. The variable consideration would be calculated as $1 million multiplied by 10 contracts multiplied by 80%, equaling $8 million. A significant financing component exists when the timing of payment differs significantly from the transfer of goods or services. This requires adjusting for the time value of money, recognizing revenue as if the settlement was in cash. The assessment of a significant financing component depends on two factors: the difference between the promised consideration and the cash selling price, and the combined effect of the time between transfer of goods and payment and prevailing interest rates. Consider a manufacturing company selling equipment on November 30th, 2015 for $2 million to be paid in 2 years with a 10% interest rate. Since there is a significant financing component, an adjustment is required. Revenue and receivables are recorded at the present value, $1.65 million. Subsequent periods will include unwinding of the discount as financial income. Non-cash consideration from a customer, such as goods or services, should be valued at its fair value to determine the transaction price. Consideration payable to a customer, like a coupon or discount voucher, is treated as a reduction from the transaction price, often serving as an incentive for further purchasing. Step 4 of the IFRS 15 model is allocating the transaction price to each performance obligation identified in the contract. If there is only one performance obligation, allocation is straightforward. For multiple obligations, the transaction price is allocated proportionately based on the relative standalone selling prices, estimated if not directly observable. A computer hardware company selling laptops and technical support has two performance obligations. The total contract price is often less than the sum of the standalone prices. In an example, a machine and 1 year's free technical support are sold for $10,000. The typical machine price is $9,000, and the cost of support is $2,000 with a 50% markup. The standalone price for technical support is estimated at $3,000, making the sum of standalone prices $12,000. The $10,000 transaction price is allocated proportionally, $7,500 for the machine and $2,500 for the support. Thank you for watching this video on IFRS 15 Revenue Recognition Steps 3 and 4. This video, part of the ACCA Financial Reporting Series, focuses on IFRS 15 revenue recognition, specifically Step 5 of the 5-step model. Our focus today is on accounting for transactions in financial statements, particularly regarding revenue. We will concentrate on the satisfaction of performance obligations over a period of time. Under IFRS 15, revenue is recognized when the performance obligation is satisfied. This involves correctly assessing the transfer of control of the promised good or service, which becomes an asset for the customer. Control is defined by the customer's ability to direct the use of the asset and obtain all substantial benefits, while also having the ability to prevent other entities from utilizing it. Benefits, in terms of potential cash flows, include producing goods, enhancing asset value, settling liabilities, reducing expenses, selling, exchanging, pledging to secure a loan, or simply holding the asset. Performance obligations can be satisfied either over time or at a point in time. The recognition of control inception dictates when the revenue is recognized. Performance obligations are transferred over time if any of three criteria are met: simultaneous receiving and consumption of benefits, creation or enhancement of an asset controlled by the customer, or no alternate use with an enforceable right to payment for completed work. The first criterion, simultaneous receiving and consumption of benefits, is exemplified by a cleaning service, where the customer benefits as the service is performed. The second criterion applies when the entity's performance creates or enhances an asset the customer controls. The asset may be tangible, like a construction contract, or intangible, such as the development of an IT system. The third criterion requires no alternate use of the asset, often due to unique design or location, and an enforceable right to payment for completed work, even if the contract is terminated. When an obligation is satisfied over time, revenue is recognized by measuring progress. The objective is to represent the entity's performance in transferring control. Two methods are used: input and output methods, and a single method must be consistently applied. Output methods measure progress based on goods or services transferred to the customer. Examples include surveys of performance, appraisals of results, milestones reached, time elapsed, and units produced or delivered. Disadvantages of output methods include the measures not being directly observable and potentially incurring additional costs to obtain data. Input methods are based on the entity's efforts to satisfy the performance obligation. These include costs incurred, resources consumed, labor hours, machine hours used, and time elapsed. A key disadvantage of input methods is the potential lack of a direct relationship between the entity's inputs and the transfer of control to the customer. Consider an example of a company building a bridge. The overall consideration is $6 million. If costs incurred are $3 million, with $2 million remaining and $2 million in milestones are confirmed, we can see the application of the methods. Using the output method, revenue is $2 million based on confirmed milestones. With the input method, the percentage of completion is $3 million incurred out of $5 million total, leading to $3.6 million in revenue. The choice of method significantly impacts reported revenue, requiring consistent application. Thank you. Welcome to this ACCA video on financial reporting. We will focus on IFRS 15 revenue recognition, specifically revenue recognition at a point in time. Under B accounting for transactions in financial statements, revenue recognition occurs when performance obligations are satisfied at a single point in time. When satisfaction of performance obligations occurs at a point in time, revenue is recognized at that same point, which is when control over the asset or service is transferred. Indicators of transfer of control include the right of payment, customer having legal title, physical possession transferred, significant risks and rewards transferred, and the asset being accepted. Transfer of control may not be apparent in cases where legal title is separate from the transfer of risks and rewards, a transaction is linked with other transactions, or options are included in the transactions. Consider example 1. Manufacturer M and retailer R on February 1st, 2015. R pays fixed monthly rentals covering insurance and maintenance. R can display machines. After sale, R pays the factory price to M. M can request R to return machines before 6 months, though it's not likely. In this example, the arrangement suggests a consignment agreement, where the retailer, R, does not take control of the product initially. Indicators of a consignment agreement include control remaining with the delivering entity until sale to the customer, the entity being able to demand a return, and no unconditioned obligation to pay. Does delivery establish a purchase for R? R incurs costs associated with inventory, and a purchase price is established at delivery. The machines can be returned within 6 months. The conclusion is that this is not a consignment agreement, and at delivery, the machines are R's assets and M's sale. In example 2, Company S sells its head office to Bank B for $15 million, with an agreement to repurchase it for $18 million. S continues to use the property and is responsible for maintenance and insurance. The question is, should S recognize revenue? Factors to consider include that Company S benefits from rising prices and from using the property. Bank B bears the risk of property price falling, and S is responsible for insurance and maintenance. The sale and repurchase arrangement is considered a repurchase agreement, where the entity sells an asset but retains the rights to repurchase it. A repurchase agreement is not a sale, but rather a secured loan. Key factors include the sale or repurchase being below fair value, the selling entity using the asset, risk and rewards not being transferred, and the sale being to a bank or financing entity. In conclusion, for example 2, Company S should not recognize a sale. The transaction constitutes a secured loan. Example 3 involves manufacturer A selling a machine and spare parts to Company B, where the spare parts are held by A for 2 to 3 years. They cannot be used or sold by A, but will be dispatched immediately upon request. This is a bill and hold agreement, where an entity bills a customer but retains physical possession. To recognize a sale in a bill and hold agreement, the arrangement must be requested by the customer, the product must belong to the customer, the product must be ready for immediate transfer, and the entity cannot sell or use the asset. If these conditions are satisfied, the sale is recognized. Thank you for watching this video on IFRS 15 revenue recognition. This video, aligned with ACCA financial reporting standards, focuses on IFRS 15 revenue recognition, specifically covering contract-related costs. Regarding significant costs in long-term contracts, incremental costs to obtain a contract, like sales commission, are recognized as an asset if recovery is expected. Costs incurred regardless of contract award are expensed. Necessary costs fulfill the contract. Necessary costs incurred to satisfy a performance obligation include direct labor and material. Costs never considered necessary are general and administrative costs and wasted material. Necessary costs are recognized as an asset only if they relate directly to the contract, enhance entity resources, and are expected to be recovered. An asset recognized is amortized on a systematic basis, consistent with the pattern of transfer. The carrying value is compared with the remaining consideration expected less remaining costs. If the carrying value exceeds this difference, an impairment loss is recognized. For an example, with a $6 million consideration and an output approach for progress measurement, 1/3 of the consideration, total cost, and capitalized cost is used for calculations. IFRS 15 requires contracts with customers to be represented as contract liabilities when consideration is received prior to performance. Contract assets and contract receivables occur when the entity has performed, but the customer hasn't paid, differing based on whether payment is conditional or unconditional. In an example where the milestone achieved is $2 million, if $3 million is already paid, there is a $1 million contract liability. If $2 million is involved and will be settled soon, it's a receivable. If the output value is measured internally without customer confirmation, it is a $2 million contract asset. IFRS 15 disclosure requirements involve qualitative and quantitative information about contracts. This includes the nature, amount, timing, and uncertainty of revenue, significant judgments, and recognized assets and impairment losses. Thank you for watching this video on IFRS 15 revenue recognition. Welcome to this video on IAS 20 government grants, focusing on the introduction and revenue grants within the ACC-AFR Financial Reporting Framework. Government grants are a form of government assistance, involving transfers of resources in return for past or future compliance with certain conditions that relate to operating activities. Government assistance refers to actions designed to provide specific economic benefits to companies qualifying under set criteria. Importantly, this does not include benefits provided indirectly. Government grants do not include assistance that cannot be reasonably valued or transactions that cannot be distinguished from normal trading transactions. The term government covers government, government agencies, and similar bodies at local, national, or international levels, ranging from a town hall to international unions. Government grants come in two main forms: capital grants, where the entity acquires long-term assets, and revenue grants, which are grants other than those related to assets. Recognition criteria for government grants require two conditions to be met. The company will comply with the relevant conditions, and the grant will be received. For an example of revenue grant accounting, upon receipt, debit cash and credit deferred income. Upon execution of the grant conditions, debit deferred income and credit profit and loss. The presentation of the credit to profit and loss can be shown as a separate line, under a general heading, or as a deduction from the related expense. Thank you for watching this video on IAS 20 government grants. This video, part of the ACCA Financial Reporting Series, focuses on IAS 20 government grants, specifically grants related to assets. For recognizing government grants, the company must comply with the relevant conditions, the grant must be received, and recognition should be based on the accrual concept. Capital grants can be presented in two ways, either by deducting the value of the grant from the carrying amount of the asset, or by recording it as deferred income. Consider an example with a construction cost of $9 million, a capital grant of $3 million, and a useful life of 12 years. The entries involve recording the non-current asset and the receipt of the grant, potentially as deferred income. Case 1 nets the grant against the non-current asset, reducing its book value to $6 million. This results in a lower annual depreciation charge of $0.5 million, recognizing the grant in the profit and loss statement through reduced depreciation. Case 2 treats the grant as deferred income of $3 million, while the asset book value remains $9 million. The grant is recognized in the profit and loss statement systematically, matching the cost over the asset's life, with an annual charge of $0.25 million. For a grant on a non-depreciable asset like land, where conditions involve incurring costs, the income is deferred. If the condition is to hire 100 employees for 4 years, the income is recognized systematically over those 4 years. If a grant for an asset becomes repayable, the accounting entries depend on the initial treatment. If the asset was reduced, you debit the asset and credit cash. If deferred income was recorded, you debit deferred income and credit cash. The cumulative effect of low depreciation is charged to the current profit and loss. Thank you for watching this video on IAS 20 government grants. Welcome to this video on IAS 21. Which covers the effects of changes in foreign exchange rates, part of the ACCA Financial Reporting course. We will start by looking at some important concepts and terms related to foreign exchange, including functional currency, presentation currency, and monetary versus non-monetary items. The functional currency is the currency of the primary economic environment where an entity operates. This is usually the domestic currency and the one in which the entity generates and expends cash. To identify the functional currency, consider the currency that influences sales prices and the currency that mainly impacts the company's labor, material, and other costs. The presentation currency is simply the currency in which an entity chooses to present its financial statements. Monetary items include units of currency held or assets and liabilities to be received or paid in a fixed number of currency units. Non-monetary items are all other assets and liabilities. Let's consider an example. An entity with a functional currency of pound sterling purchases goods for 400 Polish zloty on January 1st, when the rate is 1 pound to 4 zloty. Payment is made on January 21st, when the rate is 1 pound to 5 zloty. The initial purchase is recorded at 100 pounds. When the payment is made, 80 pounds is credited to the bank, and the 20-pound difference is debited to the profit or loss to recognize the exchange gain. Now, let's explore an alternative scenario. Assume the trade payable remains outstanding on January 31st, and the exchange rate is 1 pound to 5.33 Polish zloty. According to IAS 21, foreign currency monetary items should be translated using the closing rate, and the exchange differences are recognized in profit or loss. Non-monetary items are translated using the transaction date exchange rate. With the new rate, 400 zloty is equal to 75 pounds. The accounting adjustment is a 25-pound debit to trade payables and a 25-pound credit to profit or loss for the foreign exchange gain. Thank you for watching this video on IAS 21. This video will cover the preparation of single entity financial statements for ACCA financial reporting. We will explore single financial statements using a broad and comprehensive approach, illustrating it with full questions. The requirements of the question are to prepare the statement of profit or loss, the statement of changes in equity, and the statement of financial position. The question is available on the platform for download. Our approach will utilize the trial balance as of March 31st, 2015, which includes a lengthy list of accounts with both debit and credit balances. Remember that property, plant, and equipment is a debit balance, and accumulated depreciation is a credit balance. We also have additional information in the notes. Please pause the video now to inspect the question about the single financial statements. We start the statement of profit or loss with revenue of $132,000. Next, we determine the cost of sales, which includes the calculation from the notes, resulting in a gross profit. A key point in preparing financial statements is that items from the trial balance are used once, while items in the notes are often used multiple times. Continuing the statement of profit or loss, we have calculated the cost of sales at $103,700, yielding a gross profit of $28,300. After deducting distribution costs of $7,400 and administrative expenses of $8,000, we arrive at a profit from operations of $12,900. For finance costs, we consider loan interest, redemption of loan notes, and the suspense account balance. We also include bank interest and the unwinding of the discount on environmental provisions. The total finance cost amounts to $2,220,000. Investment income includes profits on investment sales and dividends, starting with $500,000 from the trial balance. We also factor in changes in the fair value of investments, with a closing value of $6.5 million, representing an increase of $500,000. After adjusting for the finance costs of $2,220 and investment income of $1,000, our profit before tax is $11,680. The income tax calculation involves both current and deferred tax. Current tax provision is $3.5 million, with a tax liability of $3.1 million. Deferred tax is calculated based on the taxable temporary difference, resulting in an increase of $300,000. Finally, deducting income expenses of $3,400 from the profit before tax gives us a profit for the year of $8,280. It is crucial to reference all your workings in the exam to support your calculations. To complete the preparation, ensure all trial balance items have been addressed. Then, prepare the statement of comprehensive income, which includes any gain or loss on property, plant, and equipment or financial assets. Thank you for watching this video on the preparation of single entity financial statements. Welcome to this video on the preparation of single entity financial statements, Part 2, for ACCA financial reporting. This slide shows the statement of changes in equity for the year ended March 31st, 2015. Note the balances for share capital, share premium, retained earnings, and total equity at the start and end of the period, as well as the effects of the rights issue, dividends paid, and profit for the year. Here is the statement of financial position as of March 31st, 2015. Total assets are $83,200,000, comprising non-current and current assets. Total equity and liabilities match total assets, which includes total equity, non-current liabilities, and current liabilities. Thank you for watching this video. Welcome to this ACCA financial reporting video on IAS 7, which covers cash flow, focusing on the introduction and basic definition. This introductory module focuses on the preparation of single-entity financial statements. We will cover key terms, concepts, the 3 types of business activities, advantages, limitations, analytical techniques, and the definition of cash and cash equivalents. The subsequent 4 videos will delve deeper. Videos 2 and 3 will cover operating activities using the direct and indirect methods. Videos 4 and 5 will focus on investing and financing activities. The objective of IAS 7 is to present historical changes in cash flows and enable users to assess cash generation potential. Activities are classified into operating, investing, and financing. This allows for an easy assessment of the 3 activities and overall liquidity. Remember that a single transaction, like a bank loan or loan repayment, can have multiple elements. Cash equivalents are defined as short-term, highly liquid investments. They must be readily convertible to known amounts of cash and have an insignificant risk of changes in value. The statement of cash flows excludes cash on hand, demand deposits, cash equivalents, overdraft borrowings, and overdraft repayments. Advantages of the statement of cash flows include assessing the quality of profits and being less prone to manipulation or being easily affected by accounting policy. It's more useful for debt finance providers and provides an easy assessment of liquidity. Disadvantages include that it relies on historical information, requires judgment for forecasting, and a positive cash flow does not always indicate good management. When evaluating the statement of cash flows, consider if there are signs of overtrading. Check for sufficient cash flow from operating activities, sufficient investment in non-current assets, and any necessary selling of non-current assets to maintain liquidity or issuing shares or loans. Thank you for watching this video on IAS 7 cash flow. Welcome to this video on IAS 7 cash flow, focusing on cash flows from operating activities using the direct method. Operating activities are the principal revenue-producing activities of an entity. They include activities not classified as investing or financing. These activities indicate the ability to generate cash flows, allowing for investments, and forecasting future operating cash flows. Examples of operating cash flows include receipts from sales of goods or services, receipts from royalties and fees, payments to employees, payments to suppliers, and payments or refunds of income taxes. Operating activities serve as the default category for cash flows and include acquisition-related expenses. Cash from operating activities can be reported using 2 methods, the direct method and the indirect method. The direct method reports major classes of gross cash receipts and payments. This method is encouraged by IAS 7, as it provides more useful information for projections. The information for the direct method is derived from cash records, adjusting income statement items, changes in balance inventories, receivables, and payables, other non-cash items, and items for investing or financing activities. Here we have an extract of the income statement and balance sheet for 2016 and 2015 for a single entity. To calculate the inflow from customers, we analyze trade receivables. The cash collected from customers is calculated as the opening balance plus sales minus the closing balance, resulting in $1,176,000. We are now starting to construct the cash flows from operating activities, which so far includes an inflow from customers of $1,176,000. We determine the payment to suppliers by looking at trade payables and inventory balances. Inventory purchase is $860,000. Payment to suppliers is $830,000. Next, we calculate the salaries paid to employees by analyzing the wages payable account. Cash paid for salaries is $42,000. The net cash flow from operating activities is $304,000. Remaining items, such as the sale of a fixed asset, are non-cash in nature and are presented in the remaining segments, like investing or financing activities. Thank you for watching this video on the direct method of calculating cash flows from operating activities. This video will focus on IAS 7-cash flow, specifically on cash flows from operating activities using the indirect method. The indirect method works back from income statement amounts to arrive at the same cash flow value as the direct method. This is used in the preparation of single entity financial statements. Key adjustments include changes in working capital items like inventories, trade receivables, and payables. We also adjust for non-cash items such as depreciation, provisions, deferred taxes, and items classified under investing or financing activities. Here is an example income statement and a balance sheet extract for our cash flow calculation. The net income of $288,000 is derived from the various income and expense elements shown here. Starting with net income of $288,000, we begin our adjustments. We add back depreciation of $36,000, as it is a non-cash expense. Adding back depreciation effectively removes its negative impact on the net income as a non-cash item. Next, we adjust for the gain on disposal by deducting $6,000. Gains or losses on disposals are investing activities. Deducting the gain on disposal removes this item from the operating activities to be correctly classified as an investing activity. Now we address changes in working capital. Trade receivables decreased by $24,000, inventory by $20,000, and trade payables increased by $30,000. We adjust these amounts accordingly. We can see how the adjustments for inventory and trade payables relate to the cost of sales. The result shows the cash paid to suppliers is $830,000. The adjustments serve three purposes: eliminating non-cash items, removing transactions reported under different headings, and adjusting income or expense to reflect the actual cash amount. Similar to depreciation and gain on disposal, wages are also included in the net income calculation and may need adjustment if there is a change in wages payable. After all adjustments, the cash flows from operating activities totals $304,000. A summary of adjustment rules. For trade receivables and inventory, a decrease in balance is added and an increase is subtracted. For trade payables, an increase is added and a decrease is subtracted. When trade receivables are rising, it means customers are not paying, and we subtract it from net income. When falling, it suggests receipts of cash, which we add. An increase in inventory means cash is being spent, so we subtract it. A decrease in inventory has a positive impact on cash flow, so we add it. Rising trade payables means cash savings, so we add it back. Falling trade payables indicate cash payments, which we subtract. Thank you for watching this video on the indirect method for cash flows from operating activities. This video, part of the ACCA Financial Reporting Series, focuses on IAS 7 cash flow, specifically cash flows from investing activities. Our focus today is on preparing single entity financial statements. We will be looking at cash flows classified as investing and driving cash flows using relevant information. Investing activities are defined as the acquisition and disposal of long-term assets and other investments not included in cash and cash equivalents. An example of an investing activity is the purchase or sale of a long-term bond. The placement of funds in a demand deposit is not classified as investing. Investing activities include payments to and receipts from property, plant, and equipment, intangibles and other long-term assets, equity and debt instruments of other entities, and derivative contracts such as forwards, futures, options, and swaps. Regarding cash flows, if an amount is recognized as an asset, it is eligible for inclusion in investing activities. If it is recognized in profit and loss, it is not eligible. For the treatment of dividends and interest, receipts can be classified under either operating or investing, and payments under either operating or financing. Both treatments are equally acceptable, though non-financial entities should avoid including them in operating activities, as those activities indicate cash generation abilities. A separate heading for investing activities helps determine if there are sufficient investments in non-current assets and if the entity is generating funds by disposing of assets. Here is an example for a single entity, detailing the value of property, plant, and equipment at the end of 2015 and 2016, a disposal in 2016, and other notes regarding transactions. These T accounts show the changes in PPE cost and accumulated depreciation over the period, derived from the information presented in the previous slide. Based on the example, the cash flows from investing activities include $8,000 in proceeds from the sale of PPE and a $65,000 cash outflow for the purchase of PPE, resulting in a net cash outflow of $57,000. Transactions in respect of non-current assets need to be adjusted within the operating activities section. This includes adjusting for $40,000 of depreciation and a $3,000 loss on disposal. Thank you for watching this video. This video, part of the ACCA Financial Reporting Series, focuses on IAS 7 cash flow, specifically cash flows from financing activities. Our focus today is on cash flows classified as financing activities, and we'll look at two different examples. Financing activities result in changes in the size and composition of a company's contributed equity and borrowings. Examples of financing cash flows include proceeds from issuing shares, payments to owners to acquire shares, proceeds and payments related to debentures, loans, notes and bonds, and payments by a lessee for reducing outstanding finance lease liability. Entities have a choice to present interest and dividends as either operating or financing activities. They must disclose the total amount of interest paid. Let's review an example. The table shows the ordinary share capital and share premium for December 31st, 2015 and 2016. The example includes a 1-for-3 bonus issue capitalizing retained earnings and an issue at full market price. The T accounts illustrate the transactions affecting ordinary share capital and share premium to reconcile the opening and closing balances. The cash flow from financing activities is calculated as the proceeds from the issue of shares, which is the sum of cash entries from the ordinary share capital and share premium T accounts, totaling plus 700. Here is a second example involving retained earnings and dividends payable balances for 2015 and 2016, with a net income of $800,000. The T accounts for retained earnings and dividends payable show the cash paid for dividends, which is $400,000, determined as a balancing figure in the dividends payable account. Thank you for watching this video on IAS 7 cash flow, cash flows from financing activities. This video covers consolidation workings, specifically focusing on goodwill and negative goodwill within the context of ACCA financial reporting. Let's begin with an example of preparing consolidated financial statements. In this case, P acquired 100% of S for $8,000, shown in the statement of financial positions. We can use a cost of control account to track the investment in S. The investment of $8,000 is offset by S's share capital of $3,000 and retained earnings of $2,000, leaving a closing balance of $3,000. When preparing the consolidated statement of financial positions, the $3,000 closing balance from the cost of control account is recorded as goodwill under adjustments. This leads to the consolidated totals. To summarize, the investment in the subsidiary is replaced by its assets and liabilities. The cost of investment is offset by the subsidiary's share capital and reserves. Only the parent's share capital is consolidated. Goodwill represents the excess of the purchase price over the net assets of the subsidiary. It is tested for impairment annually, but is not subject to amortization. A key principle in preparing consolidated financial statements is that the assets and liabilities of the subsidiary are initially recognized at their fair values. In example 2, let's consider a scenario where the fair value of S's other assets is $4,000 greater than its carrying value. We begin again with the statements of financial position. Using the cost of control account for example 2, the $8,000 investment is offset by S's share capital, retained earnings, and the $4,000 fair value adjustment for other assets. This results in a P&L figure of $1,000. IFRS 3 requires a reassessment of fair values. If the result is the same, this amount is credited to the consolidated income statement, represented here by the P&L amount. Applying these adjustments to the statement of financial positions, for example 2, the $4,000 adjustment to other assets is made, and the $1,000 P&L is added to retained earnings. The totals balance at $20,000. When acquisition is at the reporting date, all reported earnings generated before acquisition are eliminated. If the acquisition is before the reporting date, post-acquisition retained earnings are included in consolidation. Thank you for watching this video on consolidation workings, goodwill, and negative goodwill. This video covers consolidation workings, specifically examples related to goodwill and negative goodwill. Our current focus is on examples related to goodwill within the preparation of consolidated financial statements. We use a tabular format, and this is a valuable module for F3 exemptions. In example 1, P acquired the entire share capital of S for $8,000 on January 1st, 2017. Our goal is to prepare the consolidated statement of financial position as of that date. Working 1 shows the group structure. P owns 100% of S as of January 1st, 2017. This step is especially useful in more complicated scenarios. Working 2 details the subsidiary's net assets at the acquisition and consolidation dates using fair values. The share capital is $5,000 and retained earnings are $3,000, totaling $8,000. Working 3 calculates goodwill. The investment in the subsidiary is $8,000, less the fair value of subsidiary's net assets at acquisition of $8,000. The resulting goodwill is 0. Working 4 addresses non-controlling interest. Since the parent owns 100% of the subsidiary, this working is not applicable, as it is only relevant when the parent owns less than 100%. Working 5 calculates consolidated reserves. Parent retained earnings are $12,000, and there is 0 share of post-acquisition retained earnings, leaving total consolidated reserves at $12,000. Finally, we have the consolidated statement of financial position. Total assets are $23,000, which equals total equity and liabilities of $23,000. This includes $18,000 in total equity and $5,000 in liabilities. Thank you for watching this video on consolidation workings and goodwill examples. Welcome to part 2 of our video on consolidation workings, focusing on goodwill and negative goodwill examples for ACCA financial reporting. Let's review example 2, where P acquired the entire share capital of S for $8,000 on January 1, 2017. Here are the financial figures for S at acquisition. Continuing with example 2, this is the statement of financial position for P and S as of December 31, 2017. Our goal is to prepare the consolidated statement of financial position as of January 1, 2017. Working 1 establishes the group structure. P has a 100% ownership of S as of January 1, 2017. Working 2 focuses on subsidiary net assets. We compare the net assets at the acquisition date to the consolidation date to determine post-acquisition retained earnings. Working 3 calculates goodwill. The investment in the subsidiary is $8,000, and the fair value of net assets at acquisition is also $8,000, resulting in 0 goodwill. Working 4 addresses non-controlling interest. Since the parent owns 100% of the subsidiary, this working is not applicable. Working 5 calculates consolidated reserves. We sum the parent's retained earnings of $17,000 and the parent's share of post-acquisition retained earnings of $2,500, resulting in $19,500. Finally, we have the consolidated statement of financial position, with total assets, total equity and liabilities all equaling $34,000. Thank you for watching this video on consolidation workings, goodwill and negative goodwill examples. Welcome to part 3 of our video on consolidation workings for goodwill and negative goodwill examples as part of ACCA financial reporting. We are looking at example 3 for the preparation of consolidated financial statements. P acquired the entire share capital of S for $10,000. Note the opening balances and the fair value adjustment of $600. Working 1 shows the group structure, where P acquired 100% of S on January 1, 2017. Working 2 details the subsidiary net assets. At the acquisition and consolidation dates, net assets total $8,600, comprising share capital, retained earnings, and a $600 fair value adjustment. Working 3 calculates goodwill. Subtracting the fair value of subsidiary's net assets at acquisition from the investment in the subsidiary results in a goodwill of $1,400. Working 4, non-controlling interest, is only applicable when the parent owns less than 100% of the subsidiary. Since P owns 100% of S, this working is not relevant here. Working 5 calculates consolidated reserves. Since there are no post-acquisition retained earnings, the consolidated reserves equal the parent's retained earnings of $12,000. The consolidated statement of financial position shows total assets of $25,000, which balances with total equity and liabilities. Goodwill is $1,400, and retained earnings are $12,000. Thank you for watching this video on consolidation workings. Welcome to part 4 of our video on consolidation workings for goodwill and negative goodwill examples, focusing on ACCA financial reporting. In example 4, P acquired the entire share capital of S for $10,000 on January 1, 2017. The initial statements for S show total assets of $10,000 and total equity and liabilities of $10,000. Continuing example 4, at the date of acquisition, S's assets included a property, plant, and equipment item whose fair value exceeded its book value by $600. This PPE item had a remaining useful life of 4 years at that date. On December 31, 2017, the statements of financial position for P and S are provided, with P's total assets at $28,000 and S's at $10,000. We need to prepare the consolidated statement of financial position as of this date. Our main task is to prepare the consolidated statement of financial position for the group as of December 31, 2017, utilizing all the given information. Working 1 is the group structure. P owns 100% of S as of December 31, 2017. Working 2 calculates the subsidiary net assets. We factor in the fair value adjustment of $600 and the subsequent depreciation adjustment of $150, resulting in post-acquisition net assets of $2,350. Working 3 determines goodwill. We subtract the fair value of S's net assets at acquisition, $8,600 from the investment in subsidiary of $10,000, which results in a goodwill of $1,400. Working 4 addresses non-controlling interest. Since the parent owns 100% of the subsidiary, this working is not applicable. Working 5 calculates consolidated reserves. We add the parent's retained earnings of $17,000 and the parent's share of subsidiaries post-acquisition retained earnings of $2,350 to get consolidated reserves of $19,350. The consolidated statement of financial position shows total assets of $33,850, which includes goodwill of $1,400. Total equity and liabilities are also $33,850. Thank you for watching this video on consolidation workings. Welcome to Part 5 of our examples on goodwill and negative goodwill in consolidation workings for ACCA financial reporting. We begin with Example 5. P acquired the entire share capital of S for $7,500 on January 1, 2017. The statement of financial position for P and S are shown here. At the acquisition date, the fair value of S's other assets exceeded their book value by $600. Our task is to prepare the consolidated statement of financial position as of January 1, 2017. Working 1 shows the group structure. P owns 100% of S as of January 1, 2017. Working 2 calculates the subsidiary's net assets at the acquisition date and consolidation date, including the $600 fair value adjustment, totaling $8,600. Working 3 calculates goodwill. The investment of $7,500 less the fair value of net assets at acquisition, $8,600, results in a negative goodwill or gain on bargain purchase of $1,100. Working 4, non-controlling interest, is not applicable since P acquired 100% of S. Working 5 determines consolidated reserves. This includes the parent's retained earnings of $12,000 and the gain on bargain purchase of $1,100, resulting in total consolidated reserves of $13,100. The consolidated statement of financial position shows total assets of $23,600. Total equity is $19,100, and total equity and liabilities are $23,600, calculated as $19,100 plus $4,500 in liabilities. Thank you for watching this video. Welcome to this video on consolidation workings, focusing specifically on non-controlling interest, or NCI, for ACCA financial reporting. Let's begin with an example. Parent company P acquired 80% of subsidiary S for $6,400. The statements of financial positions for P and S are shown. When ownership is less than 100%, there are 2 approaches for goodwill computation: the proportion of net assets method and the fair value method. In the proportion of net assets approach, goodwill reflects the portion attributable to the parent only. The cost of control account shows a closing balance of $2,400, which is the calculated goodwill. The non-controlling interest represents the remaining 20% of share capital and reserves. This amounts to $600 for share capital and $400 for retained earnings. Here is the consolidated statement of financial position using the proportion of net assets approach. The NCI of $1,000 is included in total equity. An important note: when a subsidiary is not 100% owned, assets and liabilities are added without adjustment for the portion owned. The non-owned portion is reflected in the NCI share. The fair value method recognizes goodwill attributable to the group as a whole. Assuming the fair value of the 20% NCI is $1,600, the closing balance for goodwill is $3,000. The consolidated statement of financial position using the fair value method shows goodwill of $3,000 and non-controlling interest of $1,600. IFRS 3 allows a choice of goodwill measurement on a transaction-by-transaction basis. Any profits following the acquisition of the subsidiary must be apportioned between the parent group and the non-controlling interest. Thank you for watching this video on consolidation workings and non-controlling interest. This video, part of the ACCA Financial Reporting Series, focuses on consolidation workings, specifically addressing non-controlling interest using Example 1. In Example 1, P acquired 80% of S's share capital for $8,000 on January 1, 2017. The statement of financial position of S at acquisition shows total assets and total equity and liabilities of $10,000 each. Continuing Example 1, at the acquisition date, S's other assets included a PPE item whose fair value exceeded its book value by $600. This PPE item had a remaining useful life of 4 years. The statements of financial position for both P and S as of December 31, 2017, show P's total assets at $26,000 and S's at $14,000. We are given that the consolidated goodwill is impaired by $300 as of December 31, 2017. The task is to prepare the consolidated statement of financial position as at December 31, 2017. Working 1 shows the group structure. P owns 80% of S as of January 31, 2017. Working 2 calculates the subsidiary's net assets. Note the $600 fair value adjustment at acquisition and the $150 fair value depreciation adjustment at the consolidation date. Working 3 calculates goodwill. Goodwill on acquisition is $1,120. After deducting the $300 impairment, the goodwill at December 31, 2017 is $820. Working 4 determines the non-controlling interest. NCI at acquisition is $1,720. Adding the post-acquisition share of $470 gives an NCI balance of $2,190 at December 31, 2017. Working 5 calculates the group retained earnings. Starting with the parent's retained earnings of $17,000, we add the parent's share of post-acquisition profit and deduct the impairment share, resulting in group retained earnings of $18,580. The consolidated statement of financial position shows total assets of $33,270, comprised of goodwill of $820 and other assets of $32,450. Total equity and liabilities also equal $33,270. Thank you for watching this video on consolidation workings and non-controlling interest. Welcome to this video on consolidation workings for non-controlling interest. We will be going through an example for the ACCA Financial Reporting module. In Example 2, P acquired 80% of S for $8,000 on January 1, 2017. The statement of financial position of S at that date showed total assets and total equity and liabilities of $10,000. At the acquisition date, an item of PPE in S had a fair value exceeding its book value by $600, with a remaining useful life of 4 years. The fair value of the 20% non-controlling interest was estimated to be $2,000. The statements of financial position for P and S as of December 31, 2017 are provided here. Note P's investment in S is $8,000, and S has total assets and total equity and liabilities of $14,000. Additionally, consolidated goodwill was deemed to be impaired by $300 as of December 31, 2017. Our task is to prepare the consolidated statement of financial position as at December 31, 2017. Our first working, the group structure, shows P owns 80% of S, acquired on January 31, 2017. Working 2 calculates the subsidiary net assets. We include the fair value adjustment of $600 and the subsequent depreciation adjustment of $150. The post-acquisition movement is $2,350. Working 3 determines goodwill. The NCI value at acquisition is $2,000, and the fair value of S's net assets is $8,600. This results in goodwill on acquisition of $1,400. After the $300 impairment, goodwill at year-end is $1,100. Working 4 calculates the non-controlling interest. Starting with the $2,000 at acquisition, we add their share of post-acquisition profits, $470, and subtract their share of the impairment, $60, resulting in an NCI balance of $2,410. Working 5 calculates group retained earnings. We start with the parent's retained earnings, add the parent's share of S's post-acquisition profit, and subtract the parent's share of the impairment. The total group retained earnings is $18,640. Finally, the consolidated statement of financial position is prepared. Total assets are $33,550, which equals total equity and liabilities. Key components include goodwill, NCI, and group retained earnings from our workings. Thank you for watching this video on consolidation workings. Welcome to this video on consolidation workings, focusing on deferred and contingent consideration as part of ACCA financial reporting. This video is part of the section on the preparation of consolidated financial statements. We will specifically look at cases where consideration is either deferred in time, contingent upon a future event, or involves a shares exchange. Let's consider an example of deferred consideration. If P acquires S for a total consideration of $8,000, where $4,000 is payable immediately and $4,000 is payable after 3 years. According to IFRS 3 business combinations, consideration is measured at fair value on the acquisition date. This is composed of the amount payable immediately and the present value of the deferred component. In our example with a 10% discount rate, the present value of the $4,000 deferred consideration is $3,005. Thus, the total fair value of consideration is $7,005, composed of $4,000 immediate and $3,005 deferred. The deferred component is an obligation and a liability of the group, appearing in the consolidated statement of financial position. The unwinding of the discount is treated as a finance cost in the profit or loss and does not affect goodwill. Contingent consideration has a similar application. It is measured at fair value, often using probability weightage. Changes in estimates are treated under IAS 8 and are included in the total purchase price for goodwill computation. When consideration involves a shares transfer, the fair value of the shares issued equals the fair value of the purchase price. Thank you for watching this video. Welcome to this video on consolidation workings, specifically dealing with intragroup trading under ACCA financial reporting. Intragroup transactions require adjustments to eliminate the impact on profit and net asset values, even if the subsidiary is not 100% owned. Intragroup transactions take various forms, including the trading of inventory and non-current assets. For inventory remaining at year-end, unrealized profit must be eliminated. The consolidation entry varies depending on whether the sale is parent to subsidiary or vice versa, and if the subsidiary is 100% owned. For non-current assets, we compare the carrying value of the asset after transfer versus if no transfer occurred to determine the elimination figure. The entry also depends on whether the sale is by the parent or the subsidiary. Intragroup receivables and payables are offset. Adjustments are needed for cash or goods in transit by reconciling and adjusting the recipient's books. Thank you for watching this video. This video, part 1 of our examples, focuses on consolidation workings and dealing with intragroup trading for ACCA financial reporting. In example 1, P acquired 80% of S's share capital for $8,000 on January 1st, 2017. The slide shows S's statement of financial position at the acquisition date. The group uses the fair value method to measure goodwill. The fair value of the 20% non-controlling interest at acquisition was estimated to be $2,000. Here are the statements of financial positions for P&S on December 31st, 2017. During 2017, P sold goods to S for $1,800, which included a 50% markup. 1/3 of these goods remains in S's inventory at the end of the year. The objective is to prepare the consolidated statement of financial position as at December 31st, 2017. Working 1 shows the group structure, with P holding an 80% interest in S as of January 31st, 2017. Working 2 calculates the subsidiary's net assets at acquisition, consolidation date, and the post-acquisition increase in retained earnings. Working 3 calculates goodwill using the fair value method. The total consideration and NCI value is $10,000, resulting in a goodwill of $2,000. Working 4 determines the non-controlling interest balance at December 31st, 2017 by adding the NCI post-acquisition share to the NCI value at acquisition. Working 5 calculates the group retained earnings. It includes the parent's retained earnings, their share of the subsidiary's post-acquisition profit, and deducts the unrealized profit. Finally, we have the consolidated statement of financial position as at December 31st, 2017, incorporating all the calculated working values. Thank you for watching this video. Welcome to part 2 of our video on consolidation workings, focusing on dealing with intragroup trading examples for ACCA financial reporting. Let's review Example 2's acquisition details. P acquired 80% of S's share capital for $8,000 on January 1st, 2017. With S's total assets and total equity and liabilities each at $10,000. For goodwill measurement, the group uses the fair value method. At acquisition, the fair value of the 20% non-controlling interest was estimated to be $2,000. Now let's look at the statements of financial position for P and S as of December 31st, 2017. Pay attention to the investment in S, retained earnings, and liabilities for both companies. An important transaction occurred during 2017. S sold goods to P for $1,800, including a 50% markup. 1/3 of these goods remains in inventory at the year-end. The goal is to prepare the consolidated statement of financial position as at December 31st, 2017. Working 1 shows the group structure. P has an 80% interest in S, acquired on January 31st, 2017. Working 2 details the subsidiary's net assets at acquisition and consolidation dates. Note the post-acquisition retained earnings and the deduction for unrealized profit of $200. Working 3 calculates goodwill. P's investment of $8,000 plus the NCI value of $2,000 totals $10,000. Subtracting S's net assets at acquisition, $8,000, results in goodwill of $2,000. Working 4 calculates the non-controlling interest balance. The initial value is $2,000, and the NCI share of post-acquisition profits is $460, leading to a total NCI balance of $2,460. Working 5 determines the group retained earnings. P's retained earnings of $17,000 are added to P's 80% share of S's post-acquisition earnings, $1,840, totaling $18,840. Finally, the consolidated statement of financial position is presented. Total assets are $33,800, matching total equity and liabilities, which includes goodwill, share capital, retained earnings, NCI, and liabilities. Thank you for watching this video on consolidation workings. Welcome to this video on consolidation workings, focusing on intragroup trading examples, Part 3, for ACCA financial reporting. Let's review Example 3. P acquired 80% of S's share capital for $8,000 on January 1st, 2018. S's statement of financial position at the acquisition date showed total assets and total equity and liabilities of $10,000. The group uses the fair value method to measure goodwill. At acquisition, the fair value of the 20% non-controlling interest was estimated to be $2,000. On December 31st, 2018, the statements of financial position for P and S are presented here, showing their respective investment in S, other assets, share capital, retained earnings, and liabilities. Immediately after the acquisition, P sold an item of property, plant, and equipment to S for $1,000. At the time of disposal, the item had a net carrying amount of $700 and a remaining useful life of 5 years. The asset's useful economic life assessment remained unchanged. The objective is to prepare the consolidated statement of financial position as at December 31st, 2018. Working 1 shows the group structure. P holds an 80% interest in S, acquired on January 31st, 2018. Working 2 details the subsidiary's net assets at the acquisition and consolidation dates. The post-acquisition movement in retained earnings is $2,500. Working 3 calculates goodwill on acquisition. The parent's investment plus the non-controlling interest value, less the fair value of subsidiary's net assets, results in goodwill of $2,000. Working 4 calculates the non-controlling interest balance. Starting with the NCI value at acquisition, we add 20% of the subsidiary's post-acquisition retained earnings to get a total NCI balance of $2,500. Working 5 determines the group retained earnings. We adjust the parent's retained earnings and share of subsidiaries' post-acquisition profit by the unrealized profit of $180, leading to group retained earnings of $18,820. Finally, the consolidated statement of financial position is prepared. Total assets are $33,820, including goodwill and adjusted other assets. Total equity and liabilities match at $33,820. Thank you for watching this video on consolidation workings. This video is part 4 of our consolidation working series, focusing on examples of dealing with intragroup trading for ACCA financial reporting. We begin with example 4, examining selected balances from the individual statements of financial position of P and its fully owned subsidiary, S, as of December 31st, 2017. The additional information for example 4 includes $3,000 cash in transit from S to P at year-end. Also, goods dispatched by P to S, totaling $15,000, were not received by S, and their original cost was $15,000. Our task is to reconcile the relevant intragroup positions and provide the balances to be included in the consolidated statement of financial position as of December 31st, 2017. For the cash in transit, we adjust P's books. Cash increases by $3,000 to $8,000, and trade receivables from S decrease by $3,000 to $37,000. For the goods in transit, we adjust S's books. Inventory increases by $15,000 to $32,000, and trade payables to P increase by $15,000 to $37,000. After the adjustments, the updated balances are consolidated. Intragroup balances for trade receivables and trade payables are eliminated. The consolidated inventory is $72,000 and cash is $18,000. Thank you for watching this video on consolidation workings and intragroup trading examples. Welcome to this video on consolidation workings, focusing on comprehensive income consolidation, part 2, for ACCA financial reporting. We continue with the preparation of consolidated financial statements, including an associate and further adjustments. This includes group enterprises transferring non-current assets at a price other than their existing net book values. As an example, if a parent sells PPE to a wholly owned subsidiary for $6,000 with an NBV of $4,000 and a remaining life of 2 years, the parent's income statement shows a $2,000 intragroup profit. This results in the subsidiary booking the asset at an inflated price. Immediately, the parent's reported profit is debited by $2,000, and consolidated non-current assets are credited by $2,000 to adjust as if the sale hadn't happened. Subsequently, the gain is gradually realized through the depreciation charge, leading to progressively smaller adjustments. For goodwill impairment, the loss is recognized directly in the consolidated income statement. Under the proportion of net assets method, the loss is attributed fully to equity holders of the parent, changing group retained earnings. Under the fair value method, the loss is split between the parent and NCI, changing both GRE and NCI. Regarding depreciation on a subsidiary's assets, upon initial recognition, assets are revalued to fair value. This requires an adjustment to the depreciation charge in the consolidated income statement. For revaluation gains and losses, if the group follows the revaluation model, but an individual subsidiary uses historic cost, adjustments are necessary for consolidation. Thank you for watching this video on comprehensive income consolidation. Welcome to this video on subsidiary disposals for ACCA financial reporting. In the parent entity financial statements, the disposal is recorded as a debit to cash. A corresponding credit is required, and the difference is recognized as a gain or loss. Subsidiary disposal triggers include the consolidation of the subsidiary's results and the removal of the subsidiary's assets and liabilities from the consolidated statement. The gain or loss is the difference between sales proceeds and carrying amounts, recognized in the consolidated income statement. It is calculated by taking sales proceeds, less goodwill, less net assets, plus non-controlling interest. Thank you for watching this video. Welcome to this video on IAS 28, Associates and Joint Ventures. We will cover the definitions and basics of the equity method within the context of ACCA-FR financial reporting. Focusing on the preparation of consolidated financial statements, including an associate, we first need to define significant influence. This is the power to participate in financial and operating policy decisions, but not control or joint control of those policies. A holding of more than 20% generally implies significant influence, while a holding of over 50% gives the investor control. Therefore, significant influence is presumed for holdings between 20% and 50%. However, there are circumstances that can overcome the presumption of significant influence, such as the investor failing to obtain representation on the board or the investor being unable to obtain the necessary financial information. Examples of exercised significant influence include the investor's voting power being larger than any other shareholders, the investor's ability to appoint members to the board or significant committees, or the power to veto significant financial and operating decisions. There are circumstances where the equity method is not required for an associate. These include when the investment in the associate is held for sale or when the parent entity is exempted from preparing consolidated financial statements. On initial recognition, the investment in an associate is recognized at cost. The carrying amount is then adjusted by the investor's share of profit or loss and reduced by any dividend distributions received. Let's look at an example. If P acquires a 1/3 stake in A for $10,000 and A generates $9,000 in profit, with $6,000 paid out as dividends, the initial recognition is a debit to non-current assets and a credit to cash or payables for $10,000. The investor's share of the profit, $3,000, is recorded as a debit to non-current assets. The dividend received, $2,000, is a debit to cash and a credit to the investment in associate account. The final carrying amount is $11,000. The equity method requires the investor to already be preparing consolidated financial statements, meaning they must exercise control over one or more subsidiaries. If the investor only prepares individual statements, the equity method is not applied. Thank you for watching this video on IAS 28. This video covers IAS 28, focusing on consolidated workings for associates and joint ventures in financial reporting. When preparing the consolidated statement of financial position, the associate is included on a single line. This line is calculated as cost plus share of post-acquisition profit minus dividends and any impairment. Remember to also adjust for unrealized profit in inventory and combine the assets and liabilities of the parent and subsidiaries. For the group income statement, a single line reflects the share of the associate's results, which is attributed to the group's retained earnings. Any dividends are eliminated in this process. Reduction for potential impairment is an IAS 28 requirement. We apply the criteria of financial instruments and recognize additional impairment losses. However, the details are beyond the scope of this course. If the fair value of net assets at acquisition differs from the book value, an adjustment is required. This adjustment impacts the associate's share in profit or loss. If an associate is loss-making, we recognize our share of the losses until our interest equals or exceeds the interest, or until the carrying amount drops to zero. Thank you for watching this video on IAS 28, Associates and Joint Ventures. This video continues our discussion on IAS 28, focusing on associates and joint ventures, specifically regarding trading with an associate. When preparing consolidated financial statements, an associate is considered outside the group and not controlled by the parent. Therefore, the effect of transactions is generally not eliminated. For downstream transactions, such as a parent selling to an associate, the investor's share of unrealized profit is eliminated. For example, if a parent sells inventory to an associate, the profit is calculated, and the investor's share is eliminated through a debit to share of associate's profit and a credit to investment in associate. For upstream transactions, where the associate sells goods to the parent, the gains and losses are recognized only to the extent of the realized share. The journal entry to eliminate unrealized profit requires a debit to share of associate's profit and a credit to consolidated inventory. The investment in associate is calculated by starting with the cost of investment, adding the investor's share of post-acquisition gains or losses, and subtracting dividends received, impairment, and any unrealized profit in inventory, which applies only to a downstream sale. Thank you for watching this video on IAS 28, Associates and Joint Ventures. This video covers IFRS 11 for joint arrangements and IAS 27 for separate financial statements within the context of ACCA financial reporting. IFRS 11 defines a joint arrangement as an arrangement where two or more parties have joint control. Joint control is the contractually agreed sharing of control, requiring unanimous consent for relevant activities. Joint control under IFRS 11 includes two types: A joint venture gives rights to the net assets and is accounted for using the equity method, similar to an associate. A joint operation gives rights to the assets and obligations of the arrangement. IAS 27 covers separate financial statements and the possibilities for accounting for investments in subsidiaries. These possibilities include using the cost method, applying IFRS 9, or following IAS 28. Thank you for watching this video. This video, part of the ACCA Financial Reporting Series, focuses on the limitations of financial statements and their interpretation. The aim is to shift attention to the interpretation and analysis of financial statements, including the measures and techniques used for analysis, and specifically, the limitations of these interpretation techniques. Financial statements are analyzed to determine factors like return on investment, payment of obligations, and progress toward targets. The analysis measures performance against benchmarks, such as past performance, competitors, and market expectations. Ratio analysis facilitates the assessment of a company's performance. However, there is no standardized or comprehensive list of ratios, and ratio analysis is only the starting point for evaluation. The importance of financial statement analysis stems from its ease of computation. As a relative measure, it facilitates comparison and helps identify trends and shifts in relationships. Limitations of ratio analysis include relying on historical information, which may provide an incomplete picture. Also, ratios often depict the position at a single point in time. The use of alternative policies and creative accounting, along with the required judgment and interpretation, can lead to conflicting signals. Thank you for watching this video on the limitations of financial statement interpretation. Welcome to this video on the analysis of financial statements, focusing on performance ratios for ACCA financial reporting. We begin with the gross profit margin, or GPM, calculated by dividing gross profit by sales revenue. This ratio shows the percentage of revenue covering operating and other expenses to generate profit. A higher GPM indicates higher product pricing or a competitive advantage in production costs. Keep in mind that intercompany comparisons across different industries can be ineffective. Next is the operating profit margin, or OPM, which uses operating profit divided by sales revenue. The OPM incorporates a complete spectrum of operating costs. For analysis, it is necessary to distinguish between recurring and one-off events. The OPM should be interpreted in conjunction with the GPM. Other variants of profit margins include the EBITDA profit margin, the before-tax profit margin, and the net profit margin. The return on capital employed, or OCE, measures the profit earned on all capital employed. It is calculated by dividing profit by capital employed. Profit is represented by earnings before interest and tax, or EBIT, while capital employed can be defined as equity plus interest-bearing debt, or total assets minus current liabilities. ROCE can be disaggregated into the net profit margin and net asset turnover. This product highlights the efficiency at generating revenue from assets. Finally, we look at the return on equity, or ROI, which calculates the return earned on equity capital. It is calculated as net profit divided by equity. Accounting policies play a significant role in this ratio. Thank you for watching this video. Welcome to this video on the analysis of financial statements, focusing on working capital ratios, Part 1, as part of the ACCA Financial Reporting course. We begin with the inventory turnover ratio. This ratio is calculated by dividing the cost of goods sold from the income statement by the average inventory from the statement of financial position. As an example, with a cost of goods sold of $24,000 and average inventory of $12,000, the inventory turnover is 2 times per year. This tells us how many times a fill-up of inventory is needed annually. The inventory turnover period calculates how long the average inventory lasts. It's found by dividing the number of days in a period, usually 365, by the inventory turnover, or by dividing inventory by COGS and multiplying by 365. Interpreting the inventory turnover ratio indicates the resources tied up in inventory and measures the effectiveness of inventory management. A higher turnover generally suggests better management, while a lower one may indicate issues. If inventory turnover is greater than industry norms, it suggests effective inventory management, but also a risk of shortages. If it's less than industry norms, it may signal slow-moving inventory, technological obsolescence, or bulk purchases. Further factors to consider in the interpretation of inventory turnover include the predictability of demand for the product and the behavior and predictability of suppliers. Thank you for watching this video on working capital ratios. Welcome to this video on the analysis of financial statements, focusing on working capital ratios. We begin with the receivables collection period, which measures the efficiency of trade receivables collection. The formula is trade receivables divided by credit sales, multiplied by 365 days. Remember to use average figures and selling prices. Let's look at an example. Given sales revenue of $420,000 and credit sales of $360,000, with average trade receivables of $45,000, we calculate the monthly credit sales as $30,000. This example implies a credit period of 45 days. Applying the formula, we divide the trade receivables of $45,000 by credit sales of $360,000 and multiply by 365, resulting in a receivables collection period of 45.6 days. A shorter collection period indicates efficient credit and collection policies, which may include strict collection. A longer period suggests inefficient policies or collection procedures. Always compare this period with the credit policy in comparable companies. Factors to consider when analyzing the receivables collection period include factoring arrangements, special credit terms for selected customers, and the availability of data, specifically credit sales figures. Next is the payable payment period, which shows the speed with which trade payables are settled. It is calculated by dividing trade payables by credit purchases and multiplying by 365. If credit purchase data is unavailable, use total purchases or cost of sales as substitutes. Interpreting this period, a shorter period may mean taking advantage of early payment discounts, while a longer period might indicate trouble in payments or exploitation of lenient terms. The interpretation should consider the average time taken to settle payables. Finally, the working capital or cash conversion cycle measures the time elapsed from paying suppliers to collecting cash. The formula is inventory turnover period plus receivables collection period minus payables payment period. A shorter cycle is generally desirable. Thank you for watching this video. Welcome to this video on the analysis of financial statements, focusing on liquidity and solvency ratios as part of the ACCAFR financial reporting curriculum. We will be calculating and interpreting accounting ratios to address stakeholder needs. Liquidity relates to the ability to pay current liabilities, offering a short-term perspective. Solvency is the ability to meet non-current obligations, which is a long-term perspective. The current ratio, or CR, measures the adequacy of current assets to meet current liabilities. It is calculated as current assets divided by current liabilities, showing the relationship between these two components. An increasing current ratio indicates better liquidity and ability to meet short-term obligations. Historically, a CR of 2 was considered safe, but recently, 1.5 is often deemed acceptable. A ratio of 1 means current assets equal current liabilities. The quick ratio, or acid test ratio, is a more conservative measure of liquidity. It calculates the relationship between current assets, excluding inventory, and current liabilities, as inventory is considered the least liquid current asset. It is expected to oscillate between 1 and 0.7. Next, let's look at the financial gearing or financial leverage ratio, which measures the amount of debt in a capital structure. It can be expressed as debt to equity or debt to capital employed, with specific formulas for each. An increase in gearing indicates higher debt financing. Characteristics include a tax shield from interest and an increase in return on equity when profits rise. However, it also brings the risk of insolvency and limits the ability for additional debt. Higher gearing is common for companies with stable earnings. Furthermore, investors often favor borrowers that provide collateral, which can impact gearing strategies. Interest cover measures how many times profit before interest and tax, or PBIT, could cover interest payments. Increasing interest coverage signifies better solvency. A low coverage suggests shareholders are unlikely to receive dividends. Thank you for watching this video. This video will focus on the analysis of financial statements, specifically investor ratios, as part of the ACCA financial reporting curriculum. The price to earnings, or PE ratio, is calculated by dividing the current price of common stock by the earnings per share. This ratio indicates how much ordinary share investors pay per dollar of company earnings. Next is the dividend yield. It can be calculated by dividing the dividend per share by the current share price, or by dividing EPS by the dividend per share. Dividend cover is calculated by dividing the profit after tax by the dividends. A higher dividend cover suggests greater sustainability of current dividend payments. Thank you for watching this video on investor ratios. Welcome to this video on the analysis of financial statements, part of the ACCA financial reporting module. We will be examining the limitations of financial statements. Limitations of ratio analysis include being based on historic data, potentially yielding inconsistent results, requiring considerable judgment, and being distorted by accounting choices. Creative accounting intentionally misleads the reader and involves the combined use of appropriate accounting choices. Window dressing refers to intentionally carrying out transactions to distort the perception of financial statements. This can involve transactions with related enterprises as trade counterparties. Consolidated financial statements during the acquisition or disposal of a subsidiary can impact ratios and comparability across periods. An acquisition increases income, expenses, group assets, and liabilities. Mid-year disposal has similar impacts. For not-for-profit or public sector entities, financial statements have limitations as their objective is goal attainment rather than profit. These types of entities often focus on ensuring value for money through effectiveness, efficiency, and economy. Thank you for watching this video.